Welcome back, everyone. And today we're going to be covering the crash course. Okay. And that is for the current issues. Let's go for it. Okay. Reading number 94, review of the Federal Reserve's supervision and regulation of the Silicon Valley Bank. Now, describe the events leading up to the failure of Silicon Valley Bank. So we all know about this particular thing. I've also uploaded a full video for the SVB Bank. So the evolution, how it started off. So it was a California bank focused on tech and life sciences, startups, and depositors were primarily, they were venture capitalists and early stage companies. So that was a customer base of Silicon Valley Bank, okay? Focused primarily on the tech and the startups, the venture capital. They were the major depositors in the Silicon Valley Bank. Now, what really happened at the SVB Bank, how it actually happened, and what led to the failure of the SVB Bank? So SVB primarily focused on early stage tech firms. So that was a major customer base, and hence these venture capitals, they've got huge amount of money, so they deposited huge amount of money from their transactions. So deposits of SVB increased from $18 million, which was in 1983. Okay, it's such a long time ago, and 18 million to about 58 billion in 2019. And not just this, this is the main part. From 58 billion in 2019, in just 3 years, their deposits went up by $209 billion. So a 3 times increase in just about 3 years. So that was a massive deposit inflows. Now they assets grew, obviously the balance sheet, when they had the deposits, they started to grow their assets as well from 270% from this 3-year period, mainly from deposits of this particular thing. They bought the assets. This is a pointer, okay? This is a good pointer to remember. By 2022, approximately 94% of the SVB's deposit was not insured by the FDIC. So that means only 6% of the deposits were actually insured, and the other 94% was not insured. That means if anything happens to SVB, the amount is uninsured by the FDIC. So that was at risk. SVB invested these deposits in long-term securities for higher returns. Obviously, when you invest for a higher maturity bonds, you get a higher return. So they took these deposits, they invested in held to maturity securities. But decreased venture capital activity led to a reversal in deposit growth. But when the COVID-19 struck and the venture capital activity started to fall down, people, there was not money that was being deposited and so on and so forth. So people were just taking out their money, right, from the bank. So on March 8, 2023, SVB announced a significant loss from $21 billion of its securities. Why? Because interest rate began to rise. And as the interest rate began to rise, the held to maturity that they had, the securities that they had, they started to fall. Their value started to fall down because that was already fixed, right? In long-term security. So they were already fixed. The market rate was up. So their prices went down. So they faced losses here. And they started to offer an equity so that they can raise the money, right? So due to this, the loss because of the interest rate and the loss on the asset side, people got worried, right? And they started to withdraw their deposits with $40 billion requested on just one day alone. So can you imagine that? People started to take out their money thinking that they are facing huge assets, that there's a mismatch, right? And think about it, only 94% was uninsured. That means people just started to take out their money out of panic, right? That was the thing about that. On March 10, 2023, SVB was closed by the California Department of this Financial Protection and Innovation and handed over to the FDIC due to inability to meet the withdrawal demands. So it was very simple, right? I mean, if you just get a very high level thought process, the interest rates went up. They were having some fixed long-term held to maturity securities. They faced losses there. People started panicking, thinking that it will have cash flows problem. and they started to take their money out. And think about it, their customer base was about 35,000 to, roughly about that. So effectively, they had a very low customer base, but very high volume, right? Because of the venture capitalist. So that was the problem. And that's the event that led to the failure of the SVB. And now we're going to be talking about how it actually happened, what the supervisor was doing, about the oversight of the supervisory, and so on and so forth. Okay, shortfalls and deficiencies in the federal supervisory reserves supervisory oversight of the Silicon Valley Bank. Now we have to understand, this is a diagram that I've just brought from the curriculum, and if you just see that, first, if you look at this, we have a first class, that is all the global systemically important banks, the GSIBs, and they are actually managed by large institution supervision coordinating committee. Okay, so they are the ones who, kind of like a supervision for that. And when it comes to an asset with assets of $100 billion or more, if a bank has that, then they fall under this large and foreign banking organization. Okay, and if in the third class that we have it here, it's the bank with assets of less than $10 billion. So they fall under the supervision of community banking organization, okay, or regional banking organization. You can just think about that particular thing. Now here, what happened with SVB is that by policy, supervisory and regulatory standards generally increase with a firm's size and complexity. So I just told you in the previous learning objective that their assets were like $201 billion. So they are pretty much in this second class, or rather, trying to fall into that first class, right? So that was something that we had at that point in time, right? So SVB was supervised as a regional banking organization for over 20 years because they were in this particular category, while SVB was in the RBO, the regional banking officer portfolio. Examination staffing generally came from RBO and CBO. So when they moved here, generally, the supervision was done by the regional banking and community banking, a smaller version, right? Who may have had less experience with the governance and risk management practices. So the people who were supervising, okay, ideally they should have followed here. So if you read the learning objective, that the period transition from the Fed's RBO, more of like a regional, to its LFBO, which is the large and foreign banking organization. So people were still coming from this background to manage this higher version of bank, right? So they lacked the experience of governance, risk management practices, and that was one of the reasons, there was a lack of oversight. If I talk about supervisors, they did not fully appreciate the extent of the vulnerabilities as Silicon Valley Bank grew in size and complexity. I mean, just about 3 years, they went from 58 or $60 billion to approximately 3 times larger. And also, when supervisors did identify the vulnerabilities, they did not take sufficient steps to ensure that Silicon Valley Bank fixed those problems quickly enough. And we're going to be talking about the liquidity problem, internal liquidity management, and the interest rate risk they were actually facing, right? So they did not take the actions quickly enough. That was very much needed. Supervisors were slow to downgrade the supervisory ratings for these widespread weaknesses, and they were slow to downgrade the supervision which was already there, from the community or the regional banking. We don't want that. If a bank is large, we want a large financial LFBO basically to supervise them. So that was the second learning objective. Any specific risk exposures that SVB Bank had? Yes, think about it. Majority of the money was invested in the held to maturity security, which is a long term, and you cannot sell it. Okay, held to maturity. If you are a bank, you are supposed to not to transfer it to only on special circumstances. You can just, out of the accounting rules, you can just take it out from held to maturity to available for sale. So that was one thing. Deposit concentration. Look at, as I said, 35,000 approximately depositors were venture capital, right? I mean, can you imagine that? Such a low customer base and huge volume of deposits, and 94% was uninsured. So that was a specific risk exposure that they had. Available for sale securities. They even had some exposure to the available for sale, right? And this available for sale also faced losses in their portfolio. So they had twofold losses that they had. Contingency planning, inadequate preparation for liquidity. Okay, they did not manage the liquidity very well because they had a funding needs, right? People started to demand their money. So that was it. And nowadays in the technological world, all you need is just an internet connection, and you can transfer your, you don't have to virtually, physically go to a bank branch and get the money out. Just on your phone itself, you can go ahead and you can just withdraw the money or transfer the money, right? So they did not have that kind of a planning for funds, for liquidity. And obviously when they started to raise money as equity, they were, through security sales and capital raising, that was very much insufficient in this particular case, and hence they had this kind of an exposure as well. So nothing worked out in their favor is all that we can just say. That how about the SVB governance and risk management? So first off, they had inexperienced board lacked expertise for a large bank complexity. I mean, just 3 years, it went from this to the next level, right? So they did not have that complexity, and they were actually focused on short-term gains over long-term risk. Okay, their major focus was on the net interest income. That means their business model was this: I have deposits, I'm giving out maybe 5% to depositors, and I'm giving out as a loan or building up the assets held to maturity. I'm getting 7% on that, and I'm paying 5%. So 2% was the net interest that they were actually earning. So they focused more on this particular aspect, which was very much short lived. Ineffective risk management. Deficiencies include lack of risk appetite framework. So the risk appetite framework was also focused on just net interest income. So that was, risk management was not done properly as well. They had weak controls and misaligned incentives. So managers, they started to work on short-term profitability, right? Because the board was focused on short-term gains. That's the reason. Internal audit was also weak. Insufficient challenge to management. Reporting was delayed. Inadequate risk function analysis. So overall, just think about it, that internal audit even had, because things were not clear, they transitioned so fast. So everything was not seen very effectively, right? So that's internal audit issues as well. What about risk officer, chief risk officer? Well, the chief risk officer that was initially there, she lacked the necessary skills and left in 2022. Now, the bank operated without a permanent CRO for about 8 months. So no one was actually looking out for the risk aspect, right? And as I said, the CRO left, and you have a vacant position for about 8 months. No one is watching, no higher level authority is watching the risk of your organization. What do you expect? Right? So that is what is one of the governance and risk management is. On top of that, inadequate oversight from the supervisors. Supervisors, they also missed crucial red flags and were slow to address any issues like liquidity or interest risk. They were, they were slow to address those things. So that was a problem with the governance and risk management. Identify the scope of Silicon Valley Bank liquidity risk management, 30-day buffer, as well as actions the management to address these specific liquidity risk. Now, liquidity risk management and its deficiencies. So think about it. What happened is that they did the internal liquidity stress test for the SVB bank. They did it. So the SVB bank updated the liquidity stress testing internally, and that revealed significant deficiencies in managing their liquidity risk. As an example, they were showing 30-day liquidity buffer as a deficit. So a 30-day cash flow, if they need, they were in a deficit. And they termed it as operational shortfall and not a liquidity shortfall. So that's a problem. That's a problem. They modeled the stress testing, how they used the stress testing scenario analysis. The liquidity stress testing for this SVB, lacked sensitivity and realistic. That was not realism at all. With inadequate scenario analysis. So there was a problem in the stress testing scenario analysis. That is something that you can remember for the exam, right? And even the assumptions and everything was not in a good shape. What about the other one? Management responses to all the liquidity challenges. Banks' response, including increased funding and adjusting modeling assumptions, were too delayed and insufficient. So they started to game these things, right? Merely masking deeper liquidity risk and dependency on concentrated deposits. So their response to the challenging was also not very worthy enough, and something that was not good enough to actually prevent these things. As I said, they termed it as an operational shortfall. So that was something that was not something that we think about. That supervisory oversight and regulatory considerations. Oversight was very much narrowed, failing to keep pace with the growth and risk profile. They were growing from 18 to 2021. They grew massively. And regulatory standards were also not adequately enforced, highlighting broad failures in liquidity risk management practices. So they faced liquidity pressures as well. And the liquidity buffer was not, they were having a deficit. That's the core point. Okay, what about the interest rate risk management process? So now we are talking about the interest rate risk management. As I said, they overemphasized net interest income, like how much they are paying to depositors, let's say 4%, and what they are getting, from the assets, let's say 10%. So the difference was 6%. That's what they were actually focusing on. And they neglected economic value of equity metric, which is a economic value, just like economic accounting. It is economic value of equity. They ignored that, which is a very long term measure that you can actually use. So they ignored that. That means they did not think in a long term. Risk appetite statement, risk appetite only considered net interest income, limiting the perspective on interest rate risk. So that was the only focus. Not only that, there was weakness in interest rate risk policy as well. Policy lacked details on scenario analysis, assumptions analysis, limits, setting the limits, and threshold breach reporting. So there was a weakness in the interest rate risk policy. What about scenario analysis, stress testing? What about all those things? Did you even do it? But there was a weakness in that as well. And impact of short-term profits. If I talk about impact of short-term profits, removing interest rate hedges to maximize short-term net extended the portfolio duration. Now, one more thing that they did is that they wanted to protect the maturity, held to maturity securities, the net interest income. They could have hedged that particular thing. So they had a hedging program for that, but they removed that because they wanted to maximize the gain on the net interest income that they would actually get. And that in itself increased the duration or the riskiness of the portfolio. And that increased the exposure to the interest rate risk as well. So they had a hedge, but they removed it because they wanted to make more money out of this particular thing. So they removed that. So mismatch between asset and liability durations worsened the economic value of equity metric due to shift towards costlier interest bearing deposits. Okay. And as I said, what really happened is that they had that interest rate protection or hedge. They removed that just because they focus on more profits. But as the interest rate went up, their overall strategy did not work. Now the market was gaining a lot, and the asset prices, which was held to maturity security bonds, that started to fall down in value. So the assets fell down, people got panicked, they started to take out their money, right? And as the liabilities also, the deposits also fell down, the equity was taking a hit, right? Because the liabilities was invested in the assets. So that was it with the SVB bank case study, and that is all that we have. So what needs to be done is that more enhanced governance and control was also needed. Governance and control enhanced is needed. Regular reporting of both net interest income and EVE metrics to the board would have improved oversight. People, the board would have got that, and strategic decision making would have done even in a better way. That could have been the solution to this. There are more about the supervisory solutions to this, and so on. So that is something that we have it here for the SVB. Any doubts, any concern that you have before we go ahead, you please feel free to ask now. All right, let's move to the next chapter, and that is reading number 95, the Credit Suisse CoCo wipeouts, facts, misperceptions, and lessons for financial regulation. Now, this is also critically important in the current issues. So SVB, CoCo banks, they are CoCo issues, they are actually important. So describe the features and mechanics of CoCo bonds and explain the rationale for banks, why they issue them. So CoCo or contingent convertible bonds are type of convertible bond designed to automatically convert into equity during the financial distress and thus stabilizing the issuer without external intervention like a government bailout. So after the crisis, what happened was that after the crisis, people realized, right, that you need to have a bond instrument, a CoCo instrument, convertible contingent convertible bonds, wherein it's going to work like a bond in normal times, and during stress times it's going to convert into equity, so that the creditor becomes the equity holder, right? They become part of the company as against a creditor, right? So that was a major reason. At times of financial distress, you should not depend upon government bailouts. Rather, you should actually have you've converted the bond holders into equity holders. Now they are not asking money. So that is the whole and soul of CoCo or contingent convertible bonds. What are the features of CoCo bonds? Is there are triggers that are involved there. So activation. So when do you think the bonds will be converted into equity? When does that happen? Well, there are two ways that it can happen. First is going to be a mechanical trigger, which is based on predefined metrics like a drop in the bank's capital ratio. As the capital ratio falls down, there's going to be a trigger and all the bonds will be converted into equity. And the second one is a discretionary point of no viable. That means there's no point going forward, right? So that is another trigger. It is based on regulatory judgment. Now, this depends upon the regulator about the bank's viability. Will the bank be able to survive? Will it not be able to survive? What is going to be like that? So based on, it's a discretion. It is at the discretion of the regulators, what they think, what they decide. So these are the two triggers that would, trigger the conversion of the bond into equity. Okay, if it is converted now, what really happens? So when triggered, CoCos absorb losses through either they convert to equity at a predetermined rate. Maybe it's going to be listed out and you know that, okay, it's going to be converted at $10, $20, whatever the rate is. That's one thing. Or whatever principal amount of CoCos or bonds is issued, it's going to be completely write down either in partial or full amount. So if it is a complete write down, then that means they do not have, the investor loses, right? The investor loses. So that's what the complete write down is. So they can just write it off their books and that is going to be it, right? So now this is really important for us to actually go a little bit that why banks issue CoCos is because look at this Basel III capital requirement. So CoCos, they come, so this is the core equity capital, which is 4.5% of risk-weighted assets. So it's going to be a good revision for the operational risk. And up until 6% is the core equity plus 81. Now this 81 is what? Additional tier one. So this, you have preferred shares and the high trigger CoCos. That means this is the major 81 bonds, or we can say that the reason it's called 81 bonds is due to this, because it is it's in this particular bucket, plus it's a high trigger, so it falls here. And then the low trigger, they fall into this tier two as well. So this is the source for that. And as per the Basel III, you get an incentive. You must include a point of no value, no viable trigger and adhere to minimum capital requirements to qualify as regulatory capital. So it can be used as a regulatory capital as well. So that is a good thing as well. I mean, think about it. You're issuing bonds, people give you money, and you keep that money as, you know, as a bond. So that's another thing about that. Okay, this is where you need to know this particular, you know, the hierarchy or the pyramid of how things work. So whenever any kind of a bank or a company defaults or an issuer defaults, the senior debt holders, they are paid first. The subordinate debt, then they are paid. The CoCo bonds, then they are paid. And finally, we have the common equity. Any money left out, then that is going to be paid off, right? So this is something that we have the hierarchy. So you can think about it that this, you know, the lower pyramid, the common equity have the highest risk and the senior debt have the lowest risk. And when it comes to priority of money, the senior one have the highest priority of money, and this is the lowest priority of getting the money back. This is what we have it here, the basics. Now, what happened in this? I'll just give you a gist of what happened. This on the third layer or on the third pyramid, you have the CoCo bonds, right? So what the Swiss, you know, the regulators did there is that they write off this particular thing, and even before they were being paid, you know, they just eliminated that this CoCo bonds from the Credit Suisse bank. And people thought that, okay, that this is a negative thing because we are on the third layer to get the money back, but we are being pushed to even the fourth layer. So that was the problem with the CoCo bonds that they had. Okay, let's go ahead and let's try to read that. So explain the rescue. Now we are just comparing the Bear Stearns that happened in 2008 versus the Credit Suisse that just happened recently. So what are the similarities in both cases? Both rescues involved government interventions. That's the similarity. If I talk about Bear Stearns, the US Federal Reserve facilitated a merger with JP Morgan. That was a Bear Stearns case. In the Credit Suisse case, the Swiss National Bank and regulators facilitated a takeover by the UBS. So that was a similarity between these two cases. What about the differences? Why it differs from the earlier one and this one? So differences. What is the reason for collapse? Bear Stearns was exposed to subprime mortgage-backed securities. That was the reason for that. Credit Suisse was actually the collapse of SVB Bank. Problem with the SVB Bank, people started to worry about Credit Suisse. That was the reason for collapse. Rescue mechanism. Bear Stearns, they required special shareholder approval. They were asked for a shareholder approval and involved a SPV. So that was a very long and lengthy process to rescue the Bear Stearns. In the Credit Suisse case, employed a more direct takeover by UBS and debt was written down. It was written off the books. Simply, it was removed. So that was a problem with the Credit Suisse. No SPV, nothing. You know, that was majorly involved. Regulatory authority. If I talk about Bear Stearns, the US regulators used rarely invoked emergency powers. They did not use that. They rarely invoked that. About Credit Suisse, the Swiss regulators had broader legal power for intervention. So they just jumped in and they took the action of point of no viable and they completely written down. So the regulators in this particular case, they used the second trigger, and that was the discretionary or point of no. So based on this, regulator they had a judgment opinion and they used this one loss that it did not convert it to equity, but they were completely written down, completely, not even partially, completely written down. So that was a major case. Okay, explain the rationale for the write down of Swiss CoCos, why it was written off. The Swiss federal government had significant authority under the Swiss emergency law to trigger the write down of the Credit Suisse CoCo. So they had the power and the authority to do that. Specifically, the regulator, this FINMA, had the authority to trigger a conversion to equity when it determined that the Credit Suisse reached the point of no viability. It's not going to go forward. Now, the key argument of this arrangement was that CoCos functioned exactly as they were designed, by infusing equity and helping to deleverage the Credit Suisse balance sheet. So they wanted to remove the balance sheet, right? And that's what they actually did. It's you did not understand. Think about it this way. Maybe some people did not understand, or we can say that the confusion was there with the kind of triggers, right? There is a discretionary trigger as well. Maybe you did not know about the CoCos, that there is a discretionary trigger or there's a mechanical trigger, and what can happen, how the loss will be absorbed. Probably, right? That is also one of the reasons that has been suggested. But it functioned exactly as they were designed to function. That was a core thing here. Describe the reactions by the market. Now, investors were surprised. This was a negative impact, right? By the complete written down or writing off the Credit Suisse CoCos without shareholder losses. At least let the equity holders face any losses and then you write it down. If they do not have any money, like it's like you're paying them money, right? So you're as good as you're just changing the hierarchy pyramid that I've just shown. So this causes significant market reaction due to unexpectedness. Nobody expected this. Bondholders did not anticipate the written down until the day before the takeover. So they did not expect this thing. They were thinking that they are on the third level of hierarchy and then they'll be paid off first, and any losses further will be absorbed by the equity holders. That's what they thought. Now, obviously, this is a subversion of creditor hierarchy as the pyramid that I just showed you. Investors felt it violated the traditional principle of bondholders having a senior claim over the shareholder. So that was also violated. So what do you learn from this? What are the lessons that we learn? So many investors did not understand the difference between CoCo types, the high trigger, low trigger CoCos, the triggers, the automatic versus discretionary, right? The ambiguity surrounding triggers like these two triggers and a lack of clear criteria for point of no viability. Who will decide point of no viability? How do you decide that? So lack of clear criteria. So these are the lessons that we learn, that we need to be aware about all these things. The write down highlighted the need for clear communication and understanding of features of the CoCo, particularly the difference between going and gone concern scenario. So when it is a going concern, good equity, gone concern, point of no viable, right? And the differing approach from the non-Swiss regulators. Now, even so, this thing happened in Switzerland, right? So the differing approach from non-Swiss regulators like the European Union, as an example, they further fueled confusion and market unease. Even they did not, kind of like not expected this particular thing. So even they backed off on this particular thing. So that created more confusion, right? They were saying that it's not right to have to violate the hierarchy and so on and so forth. But broadly speaking, this is exactly what happened with the CoCo bonds. Okay, and that's the overall thing that you just need to know for the exam. Any doubts, any unclear thing that you have it here that you just feel that you want to know, please feel free to ask now before we move to the next chapter. Okay. So now we move forward to reading number 96, which is artificial intelligence and bank supervision. Now, usually what used to happen by 2023 is that there were almost like 7 to 8 chapters in 2023, and climate risk was a major turn up on the exam, right? There used to be like 3 to 4 questions, let's say, of climate risk. So approximately 50% was majorly on climate risk. And this time we have 10 chapters, and there's uh, going to be 8 questions on the exam, right? Of current issues. So probably you have this AI specifically focusing on the AI, we have 3 chapters for that, 3 chapters for climate risk, and the rest is spread into this and the CoCo bonds, SVB, and the other crypto system, and so on and so forth. So I feel that it's gonna be they'll not. So out of this AI three, maybe you can have 2 or 3 questions, climate risk 2 or 3 questions, and the rest will be from that. Okay, so you have to be a little bit decent in these two or three chapters that we have for AI. So let's begin. Describe the historical evolution and common types of AI-based applications used in the financial sector. So this is the historical milestone, right? In 1950, Allen publishes the foundational concepts of AI, and in 1997, the IBM's Deep Blue defeats Gary in chess, illustrating the AI's potential. So that's the historical milestone. Just give it a good read, nothing else. So what are the common types of AI-based applications in finance? In the financial sector, AI-based applications have been implemented for various purposes, including automation of back office process. That's the first thing, to automate that, not depending on manual stuff. Customer service chatbots, right? So rather than a manual individual, you can do a chat with a chat bot. Now, this is both less common in the banking industry as of now, the automation as well as this, likely due to concerns about customer satisfaction and the technology's present reality. Maybe it's not possible, to do that. But however, things are picking up. That's what the thing is. It's less common though. Fraud detection, and this is one of the most common use of AI models in banks to detect a transaction, to term it as a fraud or not fraud, like that. Credit worthiness evaluation, to evaluate whether to give out a loan or to not give out a loan. So these are the common applications that we use the AI in finance. What are the advantages of implementing the AI based applications? So what are the advantages of AI based applications in the banking? Well, you save money, cost savings. AI applications can automate the back office process, reducing the need for manual tasks. You have a better customer service. Now, these are the advantages, okay? So you have a 24/7 support, reduced waiting time is less, quick responses to customer inquiries. That's a good thing. Productivity and efficiency is getting better and better. It can free up human resources to focus more on complex tasks and value added activities. So your productivity as a human, it increases because AI can take take care of all the repetitive tasks. Fraud detection, as I said, and prevention. Banks can identify suspicious patterns and transactions in real time. So this enhances security and protects the customers. Credit evaluation and risk management. So you can make better credit decisions, right? Good risk management, improved one. You can ensure compliance with the regulatory requirements as well. So better, everything seems to be better when if you just give it out a good read for these advantages. However, we need to list out the disadvantages and difficulties for financial companies using the AI. So disadvantages, if I talk about that, loss of personal touch. AI based might reduce human interaction, right? And that can be that some people value this particular thing as well. Some people still like to go to a physical branch, even though we know that you can do it online, but some people prefer that. The other thing that we have it here is a bias. Yes, this is I think the next 2 chapters, if I just talk about it, the bias, the opaque models, these are things that we try to improve upon in the next 2 chapters. Okay, what is biasness? It obviously, as the name suggests, bias, differentiation, partiality, right? AI algorithms can inherit bias from the data that they're trained on, leading to unfair outcomes. They are giving out loans or approving the loans to a specific category. Let's say, just as an example, only males and not to females. This is a biasness. We don't want that, right? Opaque models. Now, what really happens in, at the back end of a machine learning or models, what really happens is that it is very less transparent, not very much transparent, right? And that is what we refer it to as opaque, not transparent. If I don't know what's happening, how they are, taking a decision on whether to give out a loan or not, how they are flagging it, this transaction as a suspicious or not. So I need to know that, right? So this is known as a black box. A black box is something that you really cannot see, and you really do not know what's happening at the back end, right? So that's a disadvantage of AI based applications. Evolving fraud. Fraudsters, even they adapt quickly to the new things that are happening, right? And this requires the current AI to evolve to counter their responses or schemes, whatever that thing is, right? So you need to have, the fraud is also evolving, right? So as new technologies coming up, they are also bucking. Uncertain regulation. Regulatory frameworks for AI in finance are still developing, creating an uncertain landscape. So we really don't know the regulators. Even for regulators, they need to understand these models, right? So that they can understand what are the inherent risk in it, right? So these are the disadvantages of AI-based applications. What about regulatory issues now? Again, as I said, biasness, opaqueness, transparency, all these things are major things that we just discuss in the next. We want a trustworthy AI, a AI that is, the results can be trusted, and so on and so forth, right? So I'll talk about that in the next reading. Regulatory issues. Well, biasness. All AI algorithms can perpetuate human biases, right? Requiring careful monitoring is needed to prevent any sort of discrimination. Credit scoring evolution. AI can expand credit access with wide data, a huge amount of historical data it can analyze. But fairness, now again, we're going to be talking about fairness and privacy is something that is, so what is fairness? Fairness means that you have to be equitable. Every person should get the opportunity to get a loan, to get a banking service, so on and so forth. That is fairness. And privacy needs to be protected. So that's, now these are the thought process of regulators. Whom are we talking about? Regulatory. Okay, what is their concern? Their concern is the biasness. They don't want bias. They want the credit scoring evolution to be fair, and privacy should be protected. It should not be like leaking the data and so on. Alternative data. Using non-traditional data like social media for credit scoring raises privacy concern. How can you check the social media thing, and then you just give out a loan or whatever that is? So that's, if you're dependent too much on the alternative data, that raises the privacy concern, and that is an issue to the regulators. That's what the concern is. Model opacity, as I said, the black box nature of the AI models, it also presents a challenge to the regulators who need to understand decision making process. I mean, even they cannot evaluate it properly, right? So that's a concern to the regulator. Over regulation of risk. Excessive regulation could, remember, if they have excessive regulation, that can kill or stifle innovation. And we need to adapt to the current advancement in technology. So if the regulator prevents or kind of puts a lot of regulation, innovation will not happen. So there needs to be a perfect balance as well. So these are the concerns of the regulators that we just need to know about for this particular chapter. A pretty short reading, I would say that, but overall, it just talks about the advantages, disadvantages, and what do you mean by the AI and what's used in this thing. Now, all the terminologies that we have, biasness, privacy, opaque, which is not transparent, fairness, privacy is something that we're going to be talking about in the next two chapters now. Okay. All right. Moving to reading number 97 financial risk management, and explainable, trustworthy, responsible AI. So now we are focused on these things. Describe the challenge posed by potential model bias and ethical and responsible considerations. So model bias and ethical considerations. Regulation for trustworthy AI. The European Unions, so they were the actually the first one to have this kind of an act, okay, globally, which is the AIA, or Artificial Intelligence Act, okay, Artificial AI Act. It promotes ethical AI use in complex models that requires regulatory approvals, okay, similar to just like financial regulations, and they are applicable to both static and self-learning. Self-learning learns by itself, and static is you put in the task and it just does that. Okay, so for everything we need to have regulation for trustworthy AI. If you don't know what trustworthy AI means, I'll just let you know from the next chapter, which is what we have it here. So a trustworthy, I don't know why they have put this trustworthy concept of trustworthy in the next chapter. Ideally, it should have been to the chapter that we are doing now, 97, right? But they have put it in reading number 98. So what is a trustworthy AI? Trustworthy AI, it is safe, secure, and resilient, explainable, interpretable. You are able to interpret. Privacy should be enhanced, fair with any biases should be managed. It should be accountable and transparent, and valid and reliable. So this is the diagram. If you just think about it, safe, secure, good things, right? Explainable, privacy enhanced, fair with biasness to be less, and so on and so forth. So this is the trustworthy AI. You want to have the AI to be trustworthy. So that's the trustworthy AI. Okay. And this is it. Okay. Now, self-learning models in financial services. So what are self-learning? For example, fraud detection. It learns, let's say I'm doing a transaction, or maybe someone else is doing a transaction, and they are doing one transaction, two transactions, several transactions. So it learns from all the transactions and it points out any suspicious transaction. So that's a self-learning models. So AI detects here the fraud patterns in anti-money laundering with reduce false positives. That means it is positive, but it is false, right? So you want to reduce the error. If you want to remove this false positive, you can say this thing as error with less errors. Trading models. AI conducts algorithmic trading with low explainability, affecting the trust. So you have the in trades as well. You have the algorithm trading, algorithmic trading as well, but the explainability is little less, right? And that is why traders, it's not the they do not easily trust that. Credit risk. AI decisions on credit are opaque. We really don't know how the model has approved a loan or perhaps rejected a loan. We need a better thing. We need the AI to be more of explainable. We need to understand what is the reasoning behind it, right? But still, it is the self-learning models that we have. Some things we do encourage, like a fraud detection, but some things we do not encourage is that do not be so opaque and so on and so forth, right? So that's the point of self-learning models. It learns by itself. Ethical considerations in AI, financial AI. So there are some biases that you actually want, right, to maintain fairness in risk prediction, that it should not happen that to one set of people you are just approving the loan. You want that biasness. Like you want a person with a job to get a loan, with a good income to get a loan, and not, so you specifically want that biasness. You want that differentiation, right? A job versus no job. So that's wanted bias that you actually want. However, there can be some unwanted algorithm bias as well, which results from biased data, the input, or maybe the model design is faulty, right? And that can perhaps lead to some sort of a discrimination. So that's unwanted. Data errors and misrepresentation. Due to flawed data inputs, you can have a error in the data process, misrepresentation, so on and so forth. So these are the considerations ethically that we should think about. Wanted bias, something that we don't want it in our models, and something that we cannot control, the data errors, try to control it as much as possible. But that is what we have it here. Okay, potential benefits and challenges of utilizing AI while maintaining fairness. Now, as I said in the last reading, I just spoke about it. Fairness. What do you mean by fairness? Fairness is an important goal, but it's hard to define and quantify. It's an abstract word, right? But what do you mean by fairness? If I have to give you a meaning, it involves ensuring equal allocation of benefits and cost while minimizing bias, discrimination, and any kind of stigmas. That is a fairness. You have to be fair. No discrimination. Keep it very simple. So that is the concept of fairness. Effective fairness process should include accountability mechanisms. It should be accountable or to seek restitution for unfair decisions. You should know that why there is an unfair decision. You should be able to contest that, okay, no, this is right, this is wrong. You should be able to do that. That is effective fairness process. Okay. Considerations for fairness outcomes. Now, there are few considerations that we have. One is an influenced fairness outcome that you want this. Okay. So examples include different health premiums for men and women, right? Probably you may want this, probably you may not want this. So these are influenced, right? It automatically, the health insurance premium, it is designed in a way that it has an influence on fairness outcome, right? We cannot control that. So that's one consideration that we can consider. The other thing that we have is uninfluenced consideration or uninfluenced fairness outcomes. Now, issues like gender bias is something we don't want. We don't want to just give out loans to, let's say, males or let's say females. We want to have an equal opportunity. So in credit approval process may originate from factors that are beyond the AI model control. Okay. So that's the considerations that we can have. One will be automatically influenced. The other one will not be. Now, how do you address the fairness is controllable factors, and then there are some uncontrollable factors. AI model design can mitigate bias and discrimination by ensuring equal opportunity. So you can control it. And the other one is that the society bias, systemic discrimination require broader intervention beyond. So something that you can control and something that are not controllable is the society and society bias and systemic discrimination. But you need to have your model to work on the uncontrollable factors as well. Okay, that is what the thing is. It may be a little abstract, but this is what we have it here. Okay, explain the proposed consideration for the technical validation. Now, validation, okay. Technical validation expands beyond basic model functionality to include fairness check. So what we are doing is that the chapter starts off with what is ethical considerations for AI and so on and so forth. What is fairness? Now, how do you validate whether your model or the outcome that you get is fair enough, right? How do you validate? So technical validation that you do, it expands beyond the basic functionality of a model. It goes beyond that, okay? Because you want to check whether the outcome is fair or not. Training data that you put into the model, it needs review, whether it is biased. Is there a lot of noise? Is there a lot of outliers in the training data? Because the model, if you remember the machine learning, the model, it actually builds upon the training data. So how you feed the training data, that is going to be the outcome. That's how the model will actually work. The testing should focus on solving specific problems like errors in AML model. False positive is a good thing, but if it is false, it's a bad thing. So false positive is an error in AML models. You should test it regularly. That's something that, and that should be your focus, right? Specific problems. Explainability is crucial for decisions impacting the end user. So the model should be explainable. It should have, it should not be a black box. It should not be opaque. It should be transparent, so that you know it. And finally, you have this thing, which is the auditability. That means the model can be audited, reviewed. Now, this is essential for self-learning models, requires comprehensive record keeping to trace the decisions and the model evolution, how it is building up. That is what we actually needed. So it should be auditable. That means it should be, you should, anyone can go ahead and check it out. That's what the process is. Now here we're going to be talking about one model, which is, let's say there's a portfolio of borrowers. They are put into the AI ML model, and you have a decision approved or rejected, but you really don't know why the loan was approved. Probably the person does not have a job, but still approved, and maybe it has been rejected for a qualified borrower. You really don't know. So this model does not tell you about that. So what can be done to have more transparency is that you can have an explainable AI. Now, what it does is that the same set of borrowers, you put it into the explainable AI model, and it breaks down the decision into clusters. Okay, what it does is that it breaks down into these clusters, and it classifies the, it uses a technique, let's say a line or a Shapley technique. Now, this is something that is beyond the purposes of the FRM exam. We don't have to get into it, but just know for it now. Okay, what this is that it gives value to all these categories that it has created a cluster. So in cluster number 1, you have income and credit scores. In cluster number 2, you have bad payment history and no job. So if a person has no job, it falls into this cluster, and you get a loan rejection. So now you're able to identify if it's a loan is rejected. You know that, okay, either it might be a bad payment history or maybe a no job. And if it is approved, you know that, okay, the income is good, the credit score is good. You know the reason. So that's how you have broken down using the explainable AI. You have broken down, and now you know the reason better. That's what we want, right? Transparency, explainability, interpretability. I can interpret this particular model now. Okay, so now, as I said, it works on a technology which is a SHAP value. So it gives a values to all these things, maybe 10, 12, whatever the values that you can just think of. And the values will be of certain use, not specific a part of the learning objective. So we are not getting too much into it. But this is what explainable AI is. Okay, describe the approaches and technologies that should be considered implementation and assessment of trustworthy AI. So a trustworthy AI, what is it? Adopting ethical AI practices involves harnessing the innovative potential of AI that promotes trust, fairness, explainability. So this is just 3 things here, and 7 to 8 things are there in the next readings. Just talks about trustworthy AI. Now, there are various high-level concerns, which includes privacy. Why there is a concern for trustworthy? Privacy, transparency, and optimization. Okay, so these are the concerns that we have it here. So if I talk about privacy, you should comply with the regulations and utilize methods like differential privacy, federated learning, and synthetic data generation to protect individual information. Okay, so what it can be a little technical to understand this particular thing. And so that is it. I think I'll just take you to the PPT. It's not being done well. So privacy is basically complying with regulations and utilize methods like differential privacy, federated learning, and synthetic data. So basically, you want to have a better privacy, right? So how you can build a trustworthy AI? That's the learning objective. You can focus on privacy. How? So you can you utilize method like differential privacy, federated learning. So differential privacy is that you can have a, so if you just think about it, you can have a, a differential is basically you can differentiate it as per the clustering. That's what this explainable AI does, and then you'll be able to to define that. That's what the differential privacy is. There's also concept of federated learning, which essentially talks about that you can learn from each other, right? For example, the data, let's say this particular thing that we have, there's male one, female, male, female. So the data that you're using for a bank ABC, perhaps you can have more of a another data from another bank, let's say XYZ, and then you put this into the model and then you work it out, right? So that's a federated learning. So your model is actually learning with a new data set, and that's what the federated learning is. And synthetic data generation, if you uh, remember the pseudo random number generators in level 1, that was generated by computers. You just enter one thing, one number, let's say any 3-digit number, and you have the neighbors around that particular number, right? So data was generated by computers. Similarly, you can have the synthetic data generation, and you can work out in a better way with your models. And these are the ways, differential privacy, federated learning, and synthetic data, to you can go ahead and you can enhance your model to become more trustworthy. That's what the thing is. Differential learning, see, if you feel that, let's say here also, if you just think about it, this, as I said, this cluster, there's going to be a problem, right? For example, the credit score is 650. Now it's stuck at the at this middle of the two clusters, at the border of the two clusters. So where do you incorporate this 650 score? Let's say credit score of 650. Does it come in the first cluster? Does it come in the second cluster? So we need to differentiate between these kind of things. And if you're able to better it in a better way, you'll be able to enhance the privacy. And if the concern of privacy and transparency and optimization is gone, I think that's what you have, a trustworthy AI as good as that. The second thing is the transparency, which is employing the explainable AI, like Lime and the Shaptech. So you can have explainable AI just like this particular model, the second model, as against this one, so that it's more privacy. You can understand the decision process and everything. So that's the transparency factor. There's also a third one, the optimization, is that you optimize. So you actually create a Pareto kind of a thing. Okay, you just create a diagram. Okay, it's something like this, and on the diagram you have the pointers on this particular line, right? And you select the highest pointer, and that's how you optimize this particular model. So all these three things, they'll help you to understand, or rather create, a trustworthy AI model. That is what the whole and soul of this particular chapter is. So just to give you further brief, trustworthy, it will be enhanced by having better privacy, transparency, and optimizing the model. You can have explainable this. A validation should be done for this. It should be auditable as well, the validation. You can have fairness. There are some consideration that are influenced, uninfluenced. You can address this by using some controllable factors deliberately, and some uncontrollable that you cannot control it out. That's what the thing is. And this is the model bias and ethical considerations. So this is what we have in reading number 97. Any questions that you have, please feel free to ask before we go ahead and we talk about the next chapter for the AI, and then we just wind up for the AI. At least we have other chapters to go. Okay, so now we focus on the artificial intelligence risk management framework. Now this talks about the risk management framework for the artificial intelligence. Let's go ahead. So risk management, now AI systems have to have both positive and negative impacts. AI risk management aims to minimize the negative impacts and maximize the positive ones. This is what the whole and soul of this risk management for AI. Now, this differs if you think about the risk management perspective for AI versus the traditional risk management, which focuses solely on minimizing the negative impacts. But here, you're trying to maximize the positive ones as well, which is not the case with the traditional risk management techniques. Now, the challenges in AI risk management. So, first off is the risk measurement. How do you measure the risk in AI? Well, you can use third party data, adds complexity and introduces new risks. So, if you are using some third party data, that again, it makes it more difficult to measure the risk in AI. So, these are the challenges in risk measurement. New emerging risks are difficult to identify and measure. Not it's emerging risk, right? Lack of standardized metrics across, and some potential bias can come in the existing one. So it's really hard to measure the risk. Measurement results vary depending on the AI life cycle, whether the life cycle stage that you are in for the design, whether you are on the design stage of the AI model, the development stage of the AI model, or the model has been deployed in your organization or bank. So what cycle of the AI life cycle stage, where you are, that's where the measurement of the risk will vary. Non-transparent or rather opaque AI systems are harder to measure risk for. That goes without saying. Comparing AI systems to human decision making is challenging due to different functionalities. Okay, to what human and what a human judgment can do and what AI systems can predict, that's going to be a little challenge. What about risk tolerance? Risk tolerance varies based on context, use case, and evolving policies, conventions. So, risk tolerance, how do you know how much risk can you tolerate when it comes to AI? So, risk tolerance, it varies, it depends on what is the context, what is the use case, where you're using it in a bank, insurance, what company, and evolving policies, the terminologies, conventions are changing. So, it totally depends upon that. Different organizations have different risk tolerances. So, we really cannot go ahead and we cannot identify that as well. How do you prioritize risk when it comes to AI? Well, not all risk can be eliminated. So we need to prioritize risk based on severity and the potential harm of using this AI model. So, first off, sensitive data and human impact lead to higher risk prioritization. So, obviously, if the data is sensitive and it has a higher human impact, then that deserves higher risk prioritization. And then you can just move to the other things. And all the risk that are left out, residual, needs to be documented and communicated to the end users if you are using the AI. So that's what the risk prioritization talks about. The final thing is that of organizational integration of AI in the organization. Now, AI risk needs to be considered alongside other risks, like, for example, cybersecurity. So it needs to be considered alongside to that as well. Okay, that's what the thing is. It should be, AI risk should be integrated in the organization. That's the point. You can set up controls, duties, responsibilities to people, and you can incentivize for integrated risk management that has AI in it. Cultural changes within the organization may be necessary. Maybe you'll have to change a little bit of organization culture to have this in your company or a bank. That's what the thing here is. So that is what this learning objective talks about, the challenges in AI risk management. Now, identify the AI actors across the AI lifecycle dimensions. I'll let you know what AI lifecycle dimensions are. I'll just let you know from this, the life cycle of AI basically. So this is the life cycle here. Okay, I'll just zoom in it a little bit. And this is where it actually begins from planning. So it begins like this. And then it just ends up at this operate and monitor. Okay, so it begins at planning and design, then you collect. So this is what the stage is: the plan, collect, build. So the outer circle, okay, this outer circle, the outer layer is what the life cycle is. You plan, you collect the data, you build a model, verify and validate, you deploy the data in your organization, and then you use it and you monitor and you check it out. And this is something, the internal, which the people and planet, they actually do this, the task and output and the application context. So this is the AI life cycle. Okay, but more importantly, this talks about the AI actors that we have. So across the stage of across the life cycle stages in an AI, be it plan and design, collect and process, build and use, all the, across the life cycle, who are the people, right? And what do we do? So there's a concept of a TEVV task. Okay, TEVV refers to the test, evaluation, verification, and validation at each stage. Who does that? So here, when it comes to plan and design, you focus more on the the audit and impact assessment. So you're trying to focus more on the audit and impact assessment. When you collect the data, it's internal and external validation that you do. And who would do that? The data scientist. Obviously, when it comes to data, the data scientists, data engineers, data providers. When it comes to planning and designing of a model, you have system operators, end users, the businessman, the business team. What do they want? There are designers, impact assessor, right? You're trying to do the impact assessment. When you build and use the model in that stage, what is the how the test evaluation, what is done? We're trying to, when you build and use the model, we're trying to do model testing. Who does that? There's going to be modelers, engineers, data scientists, the model engineers, and developers. So this is the AI actors that it at each stage. What do these AI actors do? That's what we just want to know. Give it a good read. There's nothing that needs to be explained. It's pretty self-explanatory, I would say that. Okay, so just this much is all. Give it a good read. Okay, no need to remember it, but just, yes, as you know it, verify. Who will do that? Modelers, again, the same people. They'll verify that. They will build and use the model as well. Deploy and use. Who will use it? Who will deploy it? Who will code it? Right, obviously software engineers, system integrated developers, they'll do that. Operate and monitor, the AI designer, they will operate and monitor. And use or impact by people. So who will use it? The end users, the bankers, the customers, and all. That's what the thing is. Okay, the AI actors, the AI risk management framework is intended to be used by AI actors across the AI lifecycle and dimensions. Ideally, AI actors will represent a variety of experience. Who are the AI actors? They will have a diversity of experience, expertise, and backgrounds, and comprise demographically and disciplinarily diverse teams. So you should have that. That's all that you need to know for AI. The actors. Describe the characteristics of trustworthy AI and analyze the proposed guidance to address them. What is a trustworthy AI? As I said, it is going to be safe, secure, explainable, interpretable, privacy enhanced. All the basics that we have talked about: explainable, secure, privacy, good, fairness, yes, accountable, transparent, yes, we want it, valid, reliable, obviously we want it. Now we talk about all of these aspects in just little details. Okay, we don't get too much into it. So what do you mean by valid and reliable, which is a major component when it comes to trustworthy AI? Valid and reliable, this is a major, if you look at the diagram, that's a major line, right? Valid and reliable. AI systems must perform their intended functions accurately and consistently over time. This is the foundation of AI trustworthiness. And yes, it is the foundation or the base, which is a valid and reliable, and is essential for garnering trust from users and stakeholders. Valid and reliable. Safe. Now we talk about the first one, which is the safe. So it should not cause harm to users or others. Safety considerations should be taken care of. It should be incorporated from the earliest life cycle stage that the model is safe to use, right? Through simulation testing, real-time monitoring, you go ahead and you do that. Secure and resilient. Withdraw. It should be able to withstand adverse events. Okay. It should maintain their functions, whatever the functionality they are providing, under change, and gracefully degrade when necessary. It should be secure. Resilient, it's bouncing back, right? That's what the third point is. Now, these involve security protocols to protect against attacks. It should be secured from attacks. Resilient, right? And mechanisms to maintain confidentiality, integrity, and availability. It should be there. That's what the point is. Okay, moving on to the accountable and transparent. AI should have clear lines of responsibility. Provide access to information regarding their operations and decision-making process. Transparency increases confidence in AI systems. That goes without saying, right? So explainable, interpretable. Stakeholders, end users should be able to understand and follow the AI's outcome and process. Privacy, enhance, protect the privacy, main point. That's it. Fair with any harmful bias, managed. It should be equitable and without any discrimination. Again, the concept of fairness that applies here. Okay, explain the potential benefits of periodically evaluating the risk management effectiveness for AI. The AI risk management framework enhances effectiveness through these following points. The first one, it talks about fostering a culture focused on identifying and managing AI risk and impact. So create a culture where people understand they can manage AI risk and their potential impact. That's a good way wherein the risk management framework for AI will be enhanced. Increasing awareness of trustworthy AI, social technical approaches, and AI risk. Awareness, culture, same thing. Expanding knowledge and capacity for testing, evaluation, verification, validation of AI systems, right? So you should have the resources, the people, the skill, the capacity, the knowledge for testing the TEVV, right? The same, the TEVV for the same. Improving risk communication and information sharing across organization, strengthening stakeholder engagement, right? And establishing clear process for AI system commissioning and deployment, enhancing organizational policies and practices for better everything, right? For accountability and governance. Just give it a good read. That's all that we have. Okay, describe specific functions applied to help organization address the risk of AI systems in practice. Now, this is the core of AI risk management framework. The core is composed of 4 specific functions: govern, map it, measure it, manage it. This, if you're able to see that, let me just zoom in a little. So this particular diagram is all that we have for the core functions of AI risk management framework. And if you see that the govern is at the center, so it's a culture of risk management is cultivated and presented. So the governance, right? Who does that? The management, the board of directors. They're at the center. Then you have a mapping. The second is a map. So here the context is recognized for the AI risk management framework, and risk related to context are identified and they are mapped. The second or the third is measure. You identify the risk, they are assessed, analyzed, and they are tracked. That's what the measurement is. And finally, you have a manage stage wherein the risks are prioritized and acted upon based on a projected impact, whatever the impact that has been projected, you go ahead and you try to manage that. So even if you remember these simple points, that is it. You don't have to get too much deep into it. Okay, this is the final learning objective for reading number 98. And with this, we are done with this particular chapter and all the AI that we have for current issues. That we will talk about here is the measurement methodologies when it comes to climate related risk. And reading number 93 talks about the various, I think there are 13 to 14 principles that needs to be followed here. Okay, the principles. Now, when it comes to the climate related financial risk measurement methodologies, we're going to be talking about various measurement things. But before I talk about measurement, understand the basics, okay, which is the transition and physical risk. Transition, it results from high carbon to low carbon when you're transitioning. Physical risk are, the physical hazards to damage any like flood or anything. Now, these functions define specific hazard impacts on activities and real assets which generate financial cash flows. Now, if I talk about these functions, though assessed separately, they can influence each other. We know that one risk can give rise to another risk. This can give rise to another risk. So that's one thing that we have. That's one issues with climate related measurement. If I try to measure the risk, I'll not be able to do that. Like specifically, I can't measure for transition and physical because they both interact. As physical risk rise, pressure on policymaker to reduce future risk may increase transition. So if there is a lot of, due to high carbon dioxide, high carbon, there's average temperature sea level rise, and that sea level rise give to maybe any physical, let's say any flood or anything like that. So physical risk is there. That's one thing happened. But the government will take action, say that, okay, that high carbon move to low carbon. So if this is rising, they may increase transition risk as well. Okay, so that they both can interact. That's one thing. When I try to measure the climate risk, think about the chapter name, which is measurement. When I try to think about measurement, how can I measure my exposure on a granular level, on a counterparty level? Can I do that? Can I understand that, okay, how will I measure to a specific counterparty whether the counterparty will be affected by a climate risk or not? That can be a challenge. So banks must decide the level of exposure granularity needed for clients and specific counterparties. There can be many factors that can influence this, like data availability of the counterparty, risk drivers, computational complexity, and risk management objectives. But yeah, that's a big challenge. How can I see or measure my exposure granularity on a granular level? Okay, I can also have, okay, this is important. High granularity, if I want it, I will use it for valuations of property, underwriting purposes. Lower granularity is needed for portfolio and planning purposes. So that's so high. If I'm doing valuations, property valuations, underwriting, then I need high granularity. I need more information on the climate risk drivers that can affect my particular property. Okay, that's what it is. I can use certain kind of approaches as well, and that is a top-down and bottom-up approaches. So top-down, it starts with aggregated risk level. So you start with the aggregated risk, and then you break it down into physical, transition, and so on. Bottom-up, it measures risk at the individual level, and then try to aggregate. So transition, this, and then you aggregate it to a climate risk level. So that's the bottom-up approach. So two different approaches that we have it here. But one thing that I need to understand is that when I use a bottom up, the individual risk, when I use that, I need to understand correlations among these risk exposures. That's one thing that I need to understand. Okay, we know that climate risk, there's a lot of uncertainty. Yes. They are dependent upon different geographies. Yes. So the uniqueness of a bank portfolio and exposure can impact all these things. So climate risk, they are heterogenetic in nature. That's one thing. Climate risk are similar within sectors, but differ among individual clients. Within a particular IT sector, maybe there's not much of a climate risk. Let's suppose that. Manufacturing sector, yes, there is. So climate risk are similar within certain sectors, but different among that. So that's another challenge that we have. Climate risk, there's a lot of uncertainty. What if you as an analyst, as a climate risk manager, what if you misestimate the climate risk? You misestimated that. Or probably you underestimated that. The assumptions that you used were not valid about interactions, emissions, technology, policy, all these things. Assumptions are needed, but so there's a lot of uncertainty when it comes to estimation of climate risk. That's another thing that we have it here. Long-term horizon in climate change modeling requires significant assumptions regarding timing and discountings. Usually you need a lot of assumptions and what if, and these are all uncertain things. Incorporating risk mitigation and risk reduction. Now, risk mitigation is crucial for climate-related financial risk measurement. This chapter focuses on risk measurement, not introduction. We have already done in the past chapter, in the last chapter. Gross exposure measures. So that there are two things, like gross exposure, the climate risk impact without any mitigation like hedging or anything like that, insurance. Net exposure after any hedging or anything like that. That's what we have it here, nothing else. So that was the first learning objective, the main issues in identifying and measuring climate related risks. Okay, it talks about transition, physical risk, the mixture of both, granularity, at what level you want, what approaches will you follow, top down, bottom up approach, any risk mitigation that you're using, and risk reduction, gross exposure you're measuring or net exposure. Any heterogeneity, because we know that it can affect within sectors, it can be same, but differ among individual clients. And finally, there can be uncertainty in terms of assumptions, in terms of the data, in terms of the misestimation, estimating basically climate risk. The next learning objective now talks about the unique data needs. Understand, if I talk about financial risk of a particular company, I can find their P&L, I can find their income statement, I can find the cash flow statement, balance sheet. How can you find for a climate risk? So we need a unique data set. Unique. And unlike the data that is used for traditional financial analysis, climate-related financial is unique and may not be fully available as well. So what do you do? Well, the following three data categories are useful, that can be helpful for assessing climate-related financial risk. First is the data that I have related to physical as well as transition risk drivers. Now here I can use information on climate and correct projected hazard event. So basically what I can use it, I can include information on current as well as projected any hazardous events. I can have a look at that. I can look at the data, including commercial third parties, any academic organizations have given the data, any government agencies have given the data. That's what I will look. Now to analyze this data, I can use scenario modeling and economic assessment, economic impact assessment I can use. So first thing that I can use for unique data, I can have the data related to physical and transition. Basically the projected current hazard events. I can use scenario modeling for understanding that, for analyzing that. The second type of data that can actually be useful is the data linking economic risk factors to exposures. Basically, I can use geospatial data. Geospatial means that kind of a data as per the different geographic locations, regions, sectors. I can go ahead and I can use that. Now, this data is used to assess how climate risk will impact specific economic regions and sectors. It includes information on the vulnerability of different assets and activities to any climate event. So I can have geospatial analysis. I can do that as per geographic locations. I can use some sector specific exposures, and I can go ahead and I can use that, and that will be helpful at least for climate related events. The third type of data that I can use is financial exposure. This data is used to translate economic risk into financial risk. Any climate event can give rise to an economic risk, and that can give rise to any financial risk. I can use that. Like, for example, I can look at the portfolio of a bank, whether they are exposed to any climate risk or not. Any specific counterparty, I can have some information about that. Any funding sources, and I can get this data from bank internal database and external sources. So basically, financial exposure data, so that I can translate any economic risk into financial numbers. Other things that I can actually consider when it comes to unique data needs is that climate risk classifications help assess financial risk. I can look at, leverage ratio, loan to value ratio. If the leverage is good, the leverage is bad, I can understand that, because you understand, if a bank has given a lot of loans, loan to value ratio, if there's a lot of thing, any damage happens to the property, maybe a flood, then the bank money is at risk. A higher money would be at risk. So I can look at these traditional ratios as well. Geographic location, that's something that I can use for that, understanding the vulnerability to climate hazards. Jurisdiction, for transition risk, I will use jurisdiction. That is crucial. Like, I can have laws, regulation, energy grids, markets may affect an entity's ability to manage it. I can go out and I can look at these things. That's part of the unique data that I'm gonna look at. Okay, now the chapter talks about measurement methodologies. So we are looking at a different current one, as well as some developing methodologies that can actually, I can use it for measuring the climate related risk. The first one is an integrated, now as the name suggests, integrated assessment. So what I'm going to do, obviously I'm going to integrate. I'm going to combine economic growth, energy, climate modeling, everything, like the growth of the country, energy, climate modeling, to link greenhouse gas emissions, transition risk, everything. I'm just going to combine it. However, they may not capture extreme weather events, and they tend to understate the severity. So that's a problem. So good thing is that, okay, I can combine it, as a together. But the bad thing is they may not capture extreme events and tend to understate the severity. So that's one integrated assessment models. The second thing that I can use is I can use the sensitivity analysis. This is useful for volatility of projected losses due to probabilities assigned to tail events. So sensitivity, obviously sensitivity means like you're targeting a specific variable. Okay, so specific tail events you are just targeting, that's sensitivity. Input output models. So here what we are trying to estimate is the economic impact of policy changing resulting from specific climate events on specific industry, like EV industry, let's say that. So input output. Computable general equilibrium models. So here you want to be, using the testing policy experiments with complex economic integrations. And overall, so basically this is more complex. This is what we have it here. But even more complex and even more dynamic is the dynamic stochastic model. And this is used for managing complexity, but like a Monte Carlo, but it requires significant computationally intensive. We have overlapping generation models. It offers a transparent way to model long-term macroeconomic changes. So you may have to remember these, just these few liners. Okay, starting from integrated, as the name suggests, you have all the integrations combinations basically, but do not capture extreme movement, understate severity. Sensitivity, you're targeting a specific tail event. Input output, you are looking at economic impact from climate event on certain industries. You're looking at certain outputs. Computable general equilibrium is you're trying to testing policy experiments, any experiments with complex economic interactions. You're looking at the equilibrium level. Dynamic one is obviously it's more like a Monte Carlo. You can have a complex but computationally intensive. You can have a overlapping thing. It provides a transparent way to model macroeconomic changes. Agent based model. Agent means like a proper like AI or something, any modeling that you're doing here, particularly used for measuring climate related, as they can handle complexity and uncertainty very well. You can have a decision making rules, you can have simulations, right? All these things, but they require substantial computational resources, just like the dynamic one. Okay, so do not get confused. Dynamic is also, but they can handle uncertainty as well, agent based. Stress testing, you can have a particular stress testing for that particular purposes. So that's what we have it here. Currently, what the bank is measuring current on a current level basis, what they're using is they are using climate risk score or ratings, basically, just like credit ratings. They have a climate risk ratings as well. So they assess climate risk exposure of entities using qualitative and quantitative criteria. So you can have a ratings for that. Scenario analysis, like projecting impacts on exposures and portfolios. You can do some scenario analysis. That's what currently they've been doing. Stress testing, the company's resilience to climate shocks. That's what you can do it. Sensitivity, impact of specific, as I said, sensitivity analysis itself means working on a specific one variable. Natural capital analysis, like how nature degradation is impacting institutions, sectors who are vulnerable, assets, and geographies. There's a concept of a climate war. Same climate value at risk. Same VAR framework to measure climate impact on an entity's balance sheet. Just like value at risk, what we calculate, same thought process we have it here. Like in liquidity, we have surplus liquidity at risk. Here we have climate value at risk, but the same thought process. This is the current bank measures that they are actually using. Okay, moving on to the climate measurement strength and weaknesses. Again, the chapter talks about measurement methodologies. So we are comparing and we're going to contrast the climate measurement methodologies utilized by banks, regulators, and third party. So we're looking at a bank level methodologies that they are using, and then we will compare it with a supervisor level methodologies. Okay, so let's look at a bank level methodologies, how they are, mapping and measuring their exposure towards to the climate risk. So on a bank level, we are talking about their particular portfolio and sector exposures. So you can identify material risk transmission channels. They are using some key indicators, like what is the collateral, which property the collateral they have given, what is the carbon intensity, energy efficiency. And I can use the qualitative as well as quantitative data for that. So when it comes to the bank level methodology for mapping and measurement of the exposures, I'm using identifying the material risk transmission channels. That's the first thing. I'm using key indicators, all these things, carbon intensity, collateral, and I'm using both qualitative and quantitative data. On a bank level, how about on a bank level, how about understanding the transition as well as physical risk? I can understand the impact of transitioning to a low carbon economy. The banks are understanding this thing. Okay, what is the impact from transitioning to a low carbon economy? The sectors that are most at risk would be the transport, utilities, oil and gas, construction. So I'm going to understand these sectors. I'm going to understand the carbon footprint of bank assets to estimate transition risk. I'm going to measure financed emissions and greenness of the financial assets. I'm going to use some alignment approaches. I'm going to analyze some green and brown activities. Green is the green, low carbon. Brown is like the in the air there's a lot of smoke, that's brown. To increase the former and reduce the latter, I'm going to reduce the brown activities. That's how we can judge the transition risk. If I want to talk about the physical risk on a bank level, I can focus on geographic concentration of risk, and I can have some physical risk scoring, geospatial data, geospatial mapping, working and analyzing specific geographies, specific locations of a branch. And I can also have a client basis, or I can have a scoring for a client. So I can evaluate, if I'm a bank, I'm going to evaluate the climate related risk and opportunities for individual counterparties. I'm going to use qualitative, quantitative component for lending decisions. I'm going to use in-house external ratings. I'm going to assess climate strategy of the client, find any vulnerability areas. I'm going to use a traffic light approach, red, green, amber. The traditional credit scores with climate scores, I'm going to complement that, the traditional with the climate scores. So these are the things that as a bank, I'm going to use it for mapping and measuring my exposure towards the climate risk from a portfolio sector point of view, to transition risk specifically, to physical risk, and to counterparty risk. If I talk about supervisors, what the supervisors are thinking and what the supervisors are doing, what methodology they are following, they are using ad hoc surveys or regulatory information. They are using these surveys. Corporate portfolios are assessed using indicators. Like, what is the same indicators? Carbon footprint, emission intensity, same, just like a bank. But they are using corporate portfolios. A sector level, entire sector level view is taken to assess which sector in the economy is most vulnerable. Real estate tends to have fewer analysis related to transition risk. That's what I can actually do it. Now, how about quantifying the risk? You have a climate risk. How can you quantify that? Well, again, two methodologies: on a bank level, on a supervisor level, because that's what the learning objective talks about. If you look at the learning objective, compare and contrast climate measuring methodologies utilized by banks, regulators, and third-party providers. So on a bank level and on a supervisor level, how the risk will be quantified? Well, I'm going to use, on a bank level, I can use stress testing, scenario analysis, analyze the impacts on portfolio, and refining methodologies. On a supervisor scale, same thing. Similar to banks, assess transition physical risk using like carbon footprint and hazard maps. Same thing. And that's how I can have a number specific for a certain thing, risk quantification. Now, what are the key takeaways? So there was a workshop that was done in 2020. There was an outreach workshop. And what are the takeaways from that? Okay, so we are now understanding a very simple thing, that what was a takeaway from the workshop. The climate related financial risks are not fully understood, and evidence of pricing in financial markets is initial stage. So climate risk is not fully understood. That's the takeaway from 2020 workshop. Banks are focusing on specific sectors for transaction and physical risk. So that's what the banks are doing. Key data sources include public reports, third-party data, and internal client data. That's what the data they are dependent upon. Banks are in pilot stages for quantifying the climate-related risk, with uncertainty in incorporating this information into existing risk management process. So they are in the pilot stage, pretty much a very nascent stage they are in right now. But that's a key takeaway. Okay, now this is the gaps and challenges in model framework design. This is one crucial learning objective, but rather very abstract one. Okay, but let's go through it. Now, what is we are trying to assess any gaps or any challenges in the model framework design. So I can have a risk differentiation. That means the transition and physical risk classifications. I can't do that. I can't have a proper classification of this is a transition, this is a physical risk. So transition and physical risk classifications are established to group exposures among identification criteria that approximate and reflect these risks. Aggregate risk classifications based on publicly information are simple, but not specific enough for counterparty differentiation. So basically what we are trying to understand here, understand the main point. We are trying to differentiate the risk. But if I have aggregate risk classifications, I will not be able to do it for specific counterparty because counterparty doing differentiation is very tough. I can add a rating or score as a complement risk assessment, but may be challenging to integrate into daily risk management. So that's one thing. Okay. What is a major challenge? The risk differentiation is a major challenge between these two things. I can have an aggregate number, but not enough for counterparty level. I can add rating score, but not, I cannot integrate it. Transition and physical risk are established to group exposures. They are grouped together. That's another gap or a challenge. Another gap or challenge when it comes to when I'm creating a model for climate risk, the framework. Another challenge is comparability across banks. So there are two obstacles to comparability. If I want to compare it, like one in one province, another in another province. So there can be jurisdiction comparability challenge. Common standards are needed for assessing risk drivers and metrics across the jurisdiction. Maybe one jurisdiction is not prone to climate risk, but another jurisdiction is very much prone to it. So how can I compare it now? That's a challenge. Developing useful cross-jurisdictional standard is a challenge. Aggregation perspective. If I talk about aggregation, like having it together, determining the risk profile of large banks can be challenging, especially when they operate across multiple jurisdictions. Consistent bank decisions may conflict with location-specific climate risk. Okay, so that's the comparability across the jurisdictions. That's what we have it here. Now, the biggest challenge, okay, when you're trying to prepare a model, a framework, the biggest obstacle to climate risk is data and information availability. What is the quality and data availability? Is it good quality data? What is the proprietary data from counterparties? Smaller counterparties may provide more qualitative than quantitative data. Obviously, they'll not talk about numbers. They'll just talk about this on a very qualitative way. So that's a challenge. Public information limitations. The informations that you have from public on a public level, they make it difficult to compare counterparties. Supervisory reporting. Supervisors can augment data gathered by banks through standardized and recurring supervisory reports. So all the supervisory reporting may not be granular enough. So that's another challenge. So if I talk about the challenges, the first thing is about the risk differentiation. You cannot differentiate between transition and physical risk. Comparability is a challenge, and there is an obstacles about the the quality of the data, the proprietary data from counterparties. You may have it more in a more qualitative way rather than a quantitative way. There can be limitations to what the publicly information is available for counterparties, and even for supervisory reporting, it may be on a very large scale basis, but not on a specific or a granular level. So that's what we have it here. Now, another gap or challenge is that of climate related financial risk complexity. It is complex. It is highly complex. So ideally, a modeling framework will allow banks to to translate that, but there are three big challenges areas for developing this framework. The first one is that of capturing economic effects. Complexity is very much in climate risk. So complexity hinders the integration of scenarios into existing banks' risk process. It is so complex that you cannot even do scenario analysis. So that's what the first thing is. Robust analysis is needed for exploring various scenarios and modeling approaches. So you need robust analysis, and current models that we have, they often overlook extreme weather events. We don't look at that. Lack of granular information for physical risk. If there is a flood, what bad can happen? Any granular things? Well, I cannot capture those economic effects. I can't do that. Any workarounds require complete data and assumptions. But that can maybe sometimes that's not going to be relevant. I may not have complete data. I may have incomplete data. And again, that can be a problem when it comes to capturing economic effects of climate risk. Other thing that we have is a long-term horizon assessment. Like, can you like predict what's going to happen for up to 30 years? It's really hard to predict for a very long term. The further the time horizon, the more uncertainty that comes in, and actual results may differ significantly from what we estimated over an extended time horizon. So that's another challenge that we have it here. And the third one is that the operational assessment challenges. So banks and supervisor need to build operational capabilities for assessing climate. You need to have operational capabilities, right? Technology systems, data management capabilities, all these are critical. Climate-related financial risk is interdisciplinary and demands investment, in-house expertise, people, and outsourced climate-specific expertise as well. So all these things, operational assessment, basically, that's a challenge here. So finally, just give a read to below points. That's what so this is the key takeaways from this particular chapter. All right, so let's start with reading number 93. Now we're going to be discussing about a lot of principles for the management of climate-related risk. So the very first principle is the assess climate-related risk. First off, find or assess, feel that climate-related risk. So we are assessing that. So we need to understand whether the climate risk is there. We need to assess the impact that risk is there. Okay, understand the impact. Consider what time horizon, short-term impact, long-term impact. Integrate this kind of risk into your business strategy. If you're planning to open a new branch near a seashore, think about it. So all the business strategies, you need to think about it. Engage board and senior management. See, all these principles are given. I've not taken the principles. I've just taken the core points. Okay. The principles, if you want to read that, it's there. Engage the board and the senior management as well. And you align with the external statements. Okay. So basically assessing, understanding the impact, horizon, integrate into business strat. These are the major points of the first principle. Now, once you assessed that, give responsibilities. Assign the responsibilities. Clearly assign management roles and responsibility. Clear that, okay, this is your role, you will handle this. Ensure knowledge and tools. I mean, people should have knowledge about climate risk, right? And the tools, the infrastructure to manage the climate risk, the people and the process. Board and senior management understanding should be there and knowledge should be there for climate risk. People should know about it. I mean, if you're talking, they don't know about physical risk, transition risk, that's not going to make sense. External specialist can be hired and training can also be given to employees on climate risk. That is desirable principle. So that's principle number 2, which is assigning the responsibility. First thing is you assess, the climate risk, whether it exists or not. The second thing is you assign the duties. You have third principle, which is adopting the policies and controls. You develop the procedures, and you implement throughout the organization all the policies towards climate risk. Okay, any controls, anything that you see, there's a control measure in place. That's the third thing. Internally, you will create, now this is a very favorite thing. I mean, first line, second line, third line of defense. Almost everywhere you will see this thing. When it comes to climate risk management, okay, here the principle says the first line should be the employee risk assessment. The employees will assess it. They will assess, they will spot that thing. During any client or onboarding, they will spot any client related risk, credit reviews, product development. If you're doing any new product development, requiring employees with the necessary knowledge and experience. So that's the very first line of defense. Basically, the people who are just working on the ground. The second line of defense is the risk department. They will conduct independent risk analysis, reviews, questioning the first line. Okay, what is did you assess any risk? Did you spot any climate related risk? And the third line is the internal audit. They will look at the audit, like, separate from these two things, independent basically. They will oversee the overall control process, including a review of both the first and second line, while also evaluating data quality. As I said, these are almost like many principles, I think 17, 18 principles. On a fresh morning, just revise these things, you'd be good to go. Principle number 5 talks about capital and liquidity adequacy. Now, you don't have to remember like, okay, what is principle number 5 and 6? That's not important. Understand the major things within there, and that's all that is needed. So you need to have capital and liquidity adequacy, because if you have a property, if it is stranded, if the asset is stranded, liquidity will take a hit. So that's what principle number 5 talks about. Assess any material risk. Identify and quantify climate related risks, include material risk over relevant time horizon. Analyze the liquidity risk. Examine short-term liquidity impact because of a stranded asset in normal and in stress time. Liquidity risk refers to significant net cash outflows and the ratios are impacted. So that's something that you need to analyze. The net cash outflows and deterioration ratios. Incorporate any risk. Incorporate climate risk into the business model, business strategy, stress testing that. So you can incorporate, the stress testing and everything like that. Gradual integration. See, integration should be there with your business strategy. Overall, climate risk should be gradually integrated with key risk identified, define relevant risk indicators and metrics for quantification. So just go through it one time. Okay. This chapter is all about you going through it. I'm just reading and I'm just trying to explain a little bit of what we have it here. Principle number 6 talks about risk management process. Risk appetite framework, just like a normal risk appetite, you have to have for a climate risk as well. Describe climate risk and include them in a risk appetite framework. Okay. Have it in your risk appetite framework. Do some periodic analysis. Okay. Perform periodic analysis. Define the impact, the materiality within the overall risk management. Concentration, if there is anything there. See, we are talking about risk management. Okay. So risk appetite, analysis, concentration risk. What risk management tools will you use? So that's you need to mention out, such as what exposures that you have for market risk. The climate risk can affect market, credit, liquidity, and operational. So what tools will you use for that? And how are you going to adapt to it? Okay. So the climate risk are dynamic. How do you adapt to the changing climate risk? That's what the 6th principle is. Moving on to the management, monitoring, and reporting. One question you can definitely expect from this chapter, but it's kind of like very theoretical. But yes, I think the basic ethics would help you to tackle these kind of questions. Ensure risk data aggregation and internal risk reporting. So it's again the same thing. The risk data aggregation and how you report, the level 1. Consider climate related financial risk for effective decision making. So they should consider this as well. When it comes to data aggregation, you need to have controls, any risk concentration. When you aggregate the data, try it. Everything should be based on climate risk. Okay. No other financial risk, only climate risk we are talking about. So controls for climate risk, you need, when you're doing the aggregation of data, you need to have some controls for this. You need to identify risk concentration, ensure data accuracy is there, enhance it. All the points that we studied for level 1, it's just here in the data aggregation. Client involvement, engage clients or counterparties for transition strategy data. When you're transitioning from a high carbon to low carbon, engage counterparties as well. Use approximation assumptions when necessary. And timely reporting. Again, the same thing, internal risk reporting, prompt reporting, accurate reporting, public disclosure should be there. All the other things that we just have it here. Again, as I said, you really have to remember it. Before your exam, just revise it once in the morning, next time in the morning, and another day, and so on. And that's how you will have a better understanding of this. Principle number 8 talks about comprehensive management of credit risk. Now we are talking about the different types of risk that can impact, that can happen via the climate risk. First is credit risk. Understand the impact of climate related risk on credit risk profiles. Okay. And incorporate any climate related risk into credit risk management. So when you're doing the credit risk management, incorporate the relevant climate risk. How do you do that? Via the policies. When you define credit policies and procedures for assessing climate. So you are doing this, into your credit risk management via these things. You are using continuous review of climate risk during credit terms. When you're giving credit, you are looking at this. You're looking at concentration, like you're using a heat map, which is there in operational risk, to measure and illustrate geographic concentration. You're using some risk management tools. Utilize risk management tools like underwriting, tightening underwriting standards, short-term loans, lower lending amounts, greater collateral. So just the risk management tools typically that you would use for a credit risk management. You can have it via policies, concentration, understand it, tools. Like these are the things that you can use. Explicitly limit exposure in undesirable sector, industry, or any specific location, which is more prone to climate changes or climate risk. Similarly, you can do it for the market risk now and understand the climate market risk. You can look at your portfolio impact, how the market risk will impact the climate risk. Climate risk will impact the market portfolio. Assess the impact of losses and the volatility on the portfolio value. You can use some scenario analysis for that when it comes to market risk. Shock scenario analysis to model the effect on the portfolio. Assess potential impact on liquidity and hedging cost. Again, you can use it for liquidity purposes as well, on the liquidity risk. Like what is going to be the cash outflow, the basic thing. What is going to be the impact of climate risk on cash that is going out of your pocket? And do you have enough liquidity buffers with yourself if there is any climate risk? Similarly, for other types of risk, which is the operational and other risk. You look at the business operations, whether climate risk in normal operations and business continuity, whether there's going to be some problem with continuity of business. Assess the impact of climate events on other business risks as well. What tools can you use for operational? I can utilize risk management tools for climate risk mitigation. Okay, I can accept all those things. Constant adaptation, recognize the dynamic nature, continuously comprehend and adapt to new climate risk. So here what we are doing is we are looking at strategic, reputational, regulatory. We are trying to understand the impact of these things on these risks. On the business operation front, on the risk management tools that I'll use to understand, to help to maintain reputation, to have business strategic decisions, for regulatory compliance and everything. And these principles now talk about the scenario analysis. Finally, when it comes to climate risk, we're talking about scenarios. Scenario analysis, you can quantify the exposure, identify key climate risk factors. What are the factors that you will have it a scenario? What scenario will you use? You don't know what the factor is. Determine effects of climate change on business operations, resiliency, address data and analysis restriction, formulate climate risk management things. So what is a goal and what is a scope? That's what you need to have for scenario analysis. What should be the scope? Short term, long term, both. Not just short term, not just long term. Revise and update scenarios to reflect current circumstances. So that's what you do as a part of the scope. Now we're going to be talking about the supervisor level. Supervisor level. Okay, we spoke about assessing, giving out roles and everything, the market risk, this, that, everything. Now we are talking about the supervisor level. So principle number 13 and all the others, it talks about supervisors now. Supervisors or the central banks or the regulators rather, they should determine the bank's incorporation of material climate risk. So they should determine that the banks has incorporated climate risk properly into their strategies and everything. So who will check whether the bank is doing that? Supervisors. Roles and duties are well documented. Check that. Supervisors should ensure board and senior management receive relevant and reliable internal information on climate risk. They should maintain regular and adequate communication with the board and senior management to ensure proactive management. So all the things that we are expecting, that's what we are saying. So like supervisors, what they should do, they should determine that the banks are doing this. The roles and duties are documented. Board and senior management are taking proactive measures. They meet them. Banks should incorporate climate risk into corporate governance as well. So supervisors will look into that. Another thing that they will do is that supervisors should determine that banks can adequately identify, monitor, and manage all material. So they should have the tools and process that they can manage everything. They should check the scope. Everything we are saying from the supervisor's point of view. If I'm the supervisor, I will make sure that the bank is understanding the scope and frequency of materiality of climate risk. Banks need to ensure that data processing and reporting abilities are sufficient. They should have the data processing and reporting abilities. Principle number 15 talks about the bank should consider multiple methods of climate risk mitigations. Supervisor analysis should be commensurate with the bank's size and operational capacity. So supervisors should analyze it. They should ensure that scenario analysis remains dynamic. That's what we have it here in terms of checking what supervisors should be doing to understand what the banks are doing. Now, these three principles, they talk about responsibilities, power, and functions of supervisors. So there are total 18 principles. Principle number 16, it talks about supervisors should use a variety of techniques and tools when they assess banks. They should establish requirements based on the scope and operational complexity of the bank. Supervisors should also have that kind of a thing, right? Whether they can analyze the banks. International cooperation between banking group is encouraged. Now, see, banks are having their branches here in other countries as well. So international cooperation is expected. Supervisors should ensure that they have adequate resources and capacity to effectively assess. Same thing. Supervisors need to be aware of the current abilities and be prepared to enhance their knowledge and skills. So supervisors should also be knowledgeable in skills. A diverse group of stakeholders should be assembled to measure and analyze climate risk. And finally, this is scenario analysis and stress testing are intended for larger and international banks. The scenario and stress testing. Supervisor should state clear goals for climate scenario, including determining the effects of that particular thing. Scenario analysis should be updated to reflect current circumstances and changes with ongoing interaction with other supervisors and banks. That should be encouraged. Overall, these principles, I would say that with a very calm and fresh mind, you just go ahead and you read that. That's going to really help you out. Okay, very important. As I said, it is an interesting chapter. All right, so let's now talk about reading number 102, which is the crypto ecosystem key elements and risk. Now, before I talk about this particular, the learning objective wise, I feel that we need to understand certain things about what the blockchain, the backend, how it actually works. Now, without getting into too much technicalities, let's say that there's one counterparty here and there's another counterparty here. They're using a payment method which is a Bitcoin. Okay, now what is happening here is that, let's say party A is making a payment in any currency and party B is paying in Bitcoins. So this is the transaction that we can actually do it. I mean, I can go ahead, or you can go ahead and you can send a Bitcoin, the other person receives it, and you pay off the money, right? The currency, the dollars, or any Great Britain pound, or whatever the currency is. Now, when you use this kind of a transaction, this is what is happening in the front end. We are just tapping on our phones and we're just using that. This is what we actually observe. But what really happens at the back end is that each of this transaction is recorded in a blockchain. Now, what is a blockchain? A blockchain is, as you know, I've just taken out this picture and I've just created this drawing. So what this blockchain is that it has a storability of data. So it's like a ledger. It's like a you have a passbook wherein you have the transaction which has been mentioned. So each block has a ledger, or a data that stores the information, like who has transferred from where to which, like all the amount and everything. So now each ledger is actually secured, and as you do more transactions, it creates a chain. And if anyone wants to change it, right, in any of this particular ledger which is stored, no one can be able to edit or change the information. What has been recorded, it has been recorded. So that's how it actually works at the back end. So gets stored in a blockchain, and that's why we refer it to as a blockchain. So the other person does that for the same Bitcoin, it gets stored in a new ledger. So another block now falls into, and it connects to this thing. So then another falls into this. So this is how the blockchain gets bigger and bigger and bigger. Now, there are certain issues with that. Okay, I'll talk about the congestion issues later, but this is what happens at the back end now. At the back end, as I said, the ledger needs to be updated and the data needs to be stored and so on and so forth. But at the very back end, what really happens is that the person, okay, who's doing the validation for whether it's a Bitcoin or another cryptocurrency. So the person does that kind of a validation, right? And we also call that person as a validator or a miner. Let's say I am a validator and I am a miner. So if I get a transaction that, okay, Mr. X wants to transfer money, or let's say US dollar to me, and someone else has to transfer Bitcoin against that, then I'm going to validate that particular transaction. Now, I can validate it by two ways. Whether if I have a good, computing power, or maybe a better system, a high-end laptop or a computing power, I'll be able to mine it. I'll be able to record it in a faster way, right? So I can work it on a very better way. So if I have a better computer, I can do it very quickly, as against someone, the other validator, let's say that they're not going to be match up to my level of computing power, right? So that's one thing. The other way that I can do it, maybe I'll accept more of fees, I'll accept more of money, and then I'll be able to go ahead and I'll be able to validate the transaction. The transaction is validated, the amount gets transferred to the respective, the counterparties that we have. This is what happens at the back end. Now, let's go through it. Let's try to read it out, and I think it will make sense. What is a blockchain technology? Now, it is a secure and decentralized digital ledger. As I said, no one will be able to view that. no one will be able to change that, basically, right? It's not edited, so it's decentralized. No one has a power, central power, no authority, no person has that. So it's a decentralized for recording the transactions. It's a network of computer stores, and so it's a network of computers which stores and verifies transactions openly. So it stored the transaction that, okay, this money has been transferred here to this to that, does that. And the transactions are pseudo anonymous. That means no one knows about it, who has sent from which to that, right? So that's a privacy is protected here. So parties' identities are hidden, but history is public. So the identity is not known, the history is public. So that's the point of the blockchain technology. So that is what we have it here. Now, the other kind of technology, or rather, which uses the blockchain, is the first element, and that is the unbacked crypto. Now, as the name suggests, unbacked. That means it is not backed by any assets. A stock or a bond is backed. Maybe it's like a futures contract. It is backed by certain kind of an asset underlying. Here, if I talk about the example of an unbacked crypto, let's say Bitcoin, it is the original form of cryptocurrency, not backed by any assets. And the value of Bitcoin is based on supply and demand. The supply, so it's the basic economics rules, right? The demand is high, the price will be high. The demand is less, the price will be less, so on and so forth. So it's very much volatile. Sometimes the Bitcoins jumps up, sometimes the supply is high, there is more supply. Obviously, there's a lot of things, no one will buy it, so that the price falls down. So it's volatility is a huge concern when it comes to Bitcoin. So the advantages is that it is decentralized. It works on the blockchain technology, good decentralization. It is secured. That's another thing that we have. And it is transparent. All the chapters that we have discussed for the AI, it is transparent. You know what this thing is. You know the transactions, but identities are hidden. That's what the point is. If I talk about the disadvantages now, the disadvantages is that it lack of intrinsic value. It does not have any value of its own, right? It's just pure supply and demand play, right? Volatility is a major concern. Sometimes it goes up, sometimes it goes down. So volatility is a huge concern, and this makes it unsuitable for everyday transactions. Sometimes the price of Bitcoin is up, you may want to store it, you may want to sell it. So that's a huge concern for unbacked crypto. Okay, the other element that we have, and that is the stable coins. What is a stable coin? It is pegged to an external asset. Think about it. I'll explain it in a very simple way. Let's say we have this USD dollar, right? And there is another coin, okay, another coin, let's say, so a Tether was the famous coin that we have it here. Okay, so this is another coin, let's call it as a stable coin. Any kind of crypto coin, we call this as a stable coin. So what it does is that this particular stable coin, it tries to match the overall the value of a US dollar. So for one stable coin, the value will be $1. So it's trying to match it up to the the volatility or the movement of the US dollar. So that is what a stable coin is. And the reason we get the name stable, why it actually generated, is because think about Bitcoin. It is so volatile that it's not stable. It is not stable. So we have this stable coins, which essentially it is pegged to an asset now that gives a better, perceived value or better thought process to investors. People want to have this stable coins because it is pegged to maybe gold prices, USD, for better stability, right? So it aims to be less volatile than unbacked crypto and acts as a medium of exchange. So rather than giving US dollars, perhaps I can give out a one stable coin. That's what the thing is. The types of the stable coins is the asset backed, so supported by real world assets, the let's say US dollar, and the other one is an algorithm. It uses complex algorithms to maintain the peg. So it can use an algorithm so that it matches to the value of the US dollar exactly. So the US dollar jumps up, the coin jumps up, falls down, stable coins also falls down. So these are the two types that we have for stable coins. Anytime that you're just confused, this is an interesting chapter, I must say that. But anytime that you're confused, please feel free to ask. Okay, there's another type of key elements of crypto is a smart contract. Now, as the name suggests, it is smart, right? Something has to do with digital. So smart contracts are like self-executing vending machines for agreements, self-executing. So they store the terms on a blockchain. So they store the data on a blockchain and automatically trigger actions when certain conditions are met. And that is how they eliminate the intermediaries and streamlining or bettering or making better the processes, right? How do they do that? Let's take an example of a collateralized loan. So the loan is now collateralized. So let's see how it actually does. So there's a there's counterparty A, there's counterparty B, and here you have a contract. So let's say this is a smart contract, right? So what you do is that the borrower and lender agree on terms and deposit collateral. So let's say this is the borrower and this is a lender. So they both agree on the on what the amount of collateral that you need to deposit as a borrower, right? Agreed. So smart contracts hold the collateral. So the collateral will be held by the smart contracts, and the loan is automatically released upon fulfilling repayment conditions. So as I said, if the conditions, as I said here, see if the conditions are met, if the repayment conditions, everything is met, everything is agreed, then collateral is automatically returned upon full payment. So what it does is that the collateral, rather than it storing with a third party, you store it in a smart contract, and once everything is sorted, it automatically returns, it gives you back. So it's a good measure. So now there's no intermediary who's holding the collateral. That is what the overall process of a smart contract is. Okay, that's what the thing is. So what they do is they automate transactions based on predefined conditions. Whatever the conditions are, if it meets, okay, done, clear. It enable complex financial applications through composability. To understand composability is that if you want to break down the larger transaction into smaller chunks, it can handle that. So it enables complex financial applications as well, and it can compose it into smaller chunks and it can analyze that. So that's why smart contracts are better, right? That's what the example of a smart contract is. The other element of the crypto is the decentralized finance. Okay, the DeFi, the decentralized finance. Financial services are built on blockchain technology under decentralized. As the name suggests, we are having a decentralization. What is decentralization? That means no central authority, right? That's decentralized finance. It offers lending, borrowing, trading, and investing without any intermediaries. Okay, so just like a smart contract. Potential benefits is that it is open, accessible, transparent, efficient. But the challenge when it comes to decentralized finance is that it's in the early stage of development, highly vulnerable to attacks or hacking, volatile, and lack of recourse for fraud. If there happens any fraud, how do you get your money back from a decentralized, which no one owns? So lack of recourse, there's no recourse going back. So that's what the problem here when it comes to this. What are the structural flaws inherent in various elements of the crypto ecosystem? And this scalability trilemma is very important concept. Okay, so let's try to understand that particular thing. Blockchain, it says that it is decentralized, it is open, it's good, everything is better about that, right? Let's look at the structural flaws that are there in each of the products or cryptos that we have just spoken about. First thing when it comes to blockchain is congestion. What is congestion? Congestion is, think about it, is if you can see this is a blockchain here, and you see this, all the other blocks are so much congestion, right? Everyone is on Bitcoin, let's suppose that. Then automatically a lot of people, they come in, then obviously there's going to be a lot of congestion, there's going to be crowd, right? That's what the thing is. And what happens is that, as I told you, who validates the transaction, who process the transaction? The validators. They process the transaction. So crypto congestion occurs when a cryptocurrency network is not processing transaction quickly to meet the demand. During periods of congestion, what's going to happen? During periods of congestion, high fees for validators, right? As their transaction. So you will pay high, and I will pay, no, take my money, I'll give more money to validate my transactions. So you see what is happening? A lot of congestion, people are paying up more and more. So validators, they earn more fees for that. There's going to be higher transaction fees for the users, as users are forced to pay more to use congested blockchain. That's what the congestion is. So the blockchain capacity problem is one result of what we call as scalability trilemma. What it means is that whereby blockchains can only achieve two of the following three properties. Now, as I said, remember this thing out. If you have a blockchain, you want it to be decentralized so that no one controls it. Fair enough. You want it to be scalable so that everyone, it's a cryptocurrency. What if the paper money is gone? Everyone is using Bitcoin. That means is it scalable enough? Is it scalable? If you and I are using it, that's two people are using it. Let's say you are using, I'm using, this person is using, that person is using. Now, so it is scaling, right? So that's the second aspect that you want in a blockchain. And third one is also the security, right? That means you want to have the blockchain as secured as possible. When it comes to congestion, there's a problem of scalability trilemma. Now here, out of the three things, only two things you can pick it up, and one thing will take a hit. Okay. So if you, let's read it out. Okay. So security is the ability to protect from attack. So if you have a lot of people, and there's going to be a concept of decentralization. That means, think about it. If there are a lot of fees for validators, if they are charging you a lot of fees, okay, then obviously they are controlling someone. If I have, or let's say I have I take a lot of fees, but then I do the transaction very quickly. I can get it validated very quickly. Wouldn't you pay it to me? Yes, because if you want it to be very urgent, you'll do that. Similarly, so what I'm doing is that I'm getting an authority which I do not want. So there is no decentralization that is really there. So if I'm looking out for scalability, and if I'm looking out for having more secured, somewhere or the other, I'll compromise on decentralization. If I'm looking on decentralization and security, I'll not be able to scale it, because if I scale it, there's a decentralization problem. If I don't scale it, then obviously that is already gone, right? So two of the things I can pick it up. What is decentralization? It's the distribution of power, not only the hands of a few who has a lot of computing power or maybe charging high fees, but they get the work done, right? So that's decentralization. Scalability is the ability to process many transactions per second, right? So that's the congestion here. And I think this is something that we need to spend a little time on. So that's the scalability trilemma. Now, the other aspect or the structural flaws is that of fragmentation. So what fragmentation does is that what you can do is, probably if you have a lot of congested blockchain, then you can divide it into divided into pieces or chunk, and these, now think about it, they are more secured, right? It's kind of like you try to break down such a large volume into smaller chunks. So you're trying to break down these larger into smaller blockchains. That's what you do, and that is what we mean by the fragmentation here. So if I just talk about it, fragmentation, the cryptocurrency markets divide into many different and often incompatible blockchain networks. So you have these networks, but they are incompatible with each other. Now, these newer blockchains often feature a higher ability to process transactions, good ability because they are smaller, as I said, less scale, but weaker security and increased centralization. Again, the scalability trilemma that we have it here as well. So this has led to proliferation of different blockchains and applications, each with its own set of rules and features. Now, crypto fragmentation can lead to several problems, include the following. If you try to break it down into pieces, what are the problems? Lack of interoperability. You cannot operate it on an interoperability. That's a problem. Assets or data cannot be easily exchanged between blockchains. I cannot operate it on an inter level. Rise of hacks and theft. Probably the hackers can hack, if not a huge system, they can hack a smaller system. So that's going to be there. Decrease network effects. Users are less likely to use a blockchain if it is incompatible with other popular blockchains. Maybe if this is a different blockchain, this is a different blockchain, it's not going to be, people will not be interested in all, right? That's what the, problem with the fragmentation is. Okay, the other structural flaws that we have that relates to the stable coins and nominal anchors. What, as I said, stable coins. So there's a, let's say, a Tether USD. That's this stable coin is pretty much pegged to the value of the US dollars, right? As the US dollar fluctuates, they try to match it to that. Now, in stable coin, you have to find a stable anchor. Now, what is an anchor here? Just understand the concept here. Stable coins struggle to maintain a stable value if the assets backing them are not transparent and high quality. So now we know that US is high quality and it's transparent as well. But if you try to peg it to an anchor which is not stable in itself, okay, maybe you try to peg it to another asset, right? That is going to give you a problem. So that's the thing that we have for a stable or a nominal anchor. So stable coin, by its very structure, it is going to be pegged to an asset, right, to make it more stable. But if that asset is in itself is not stable, that is going to be a problem, right? So searching that particular anchor is a big task, right? That's one thing. And the other aspect is the risk of risky investments. Let's say I bought a Terra USD or this Terra USD, whatever the stable coin is. I bought that. That means I gave the money, right? The money went out from my pocket. Now that money, the invest the whatever the Terra, what they do is the people on that, what they do is they try to invest that money in risky investments so that they can get better returns and they can pass on to me that better returns. And I can say that, yes, invest in Terra USD. So stablecoin issuers may be tempted to invest in risky assets for higher returns, potentially jeopardizing the stability of the stablecoin. So it is managed. You give the money, right? I've given the money. If I need to get back my money, right? So what they do is that they try to invest that money and probably in risky assets. So that is a problem or the structural flaws that we have for stable coins as a crypto. The other structural flaws that we have is a false decentralization claim. We are talking about decentralization, but it's a false claim. Despite claims of decentralization, power often concentrates in the hands of a few validators. Think about it. There's a concept of proof of work and proof of stake. So proof of work, the competition for block validation leads to concentration among miners with high computational power. And the proof of stake is that collateral requirements can lead to power concentration among those with the most coins. Okay, think about it. If you have, I've written out here as well in this particular thing. So as I said, what happens in the back end is the validator or the miner, he goes ahead and he mines that, validates the transaction, everything is approved here. So he has, if a validator has a good amount of computing power, everyone will go to this particular person. He'll be able to mine it effectively, basically, right? So this is a proof of work. So with it, if so, this is a false decentralization. Think about it. I'm talking that blockchain has to be decentralized. No one should control it. No one should have the authority. But this validator or a miner has a better computing power, and that is the reason he's able to better validate it. And everyone is, so you are transacting with him, I am transacting with him. So now he has a authority, he has that central power. That is what the problem is. That's the structural flaws. The other thing is that of a proof of stake. The more money that he has, the more coins that he has, right? So everyone will reach out to him again. And again, this gives this particular validator or a miner the authority to mine in a better way, or to validate the transactions quickly. That is what the whole and soul concept is. So we are saying that it is a decentralized thing, the blockchain and everything, but it's a false claim, as we just saw in those 2 points. So this is congestion. So this is the false decentralization claims. So proof of work, it's a competition for blockchain leads to concentration among miners, and proof of stake is that the collateral requirements can lead to power concentration among those with the most money or most coins. So what to do? We can use centralized exchanges. So this is again a structural flaws as well. Centralized exchanges. If I talk about an exchange which is centralized, right, despite promoting decentralization. Now, this is the irony here. Despite promoting decentralization, most trading activity happens on centralized exchanges with centralized control and potential risk. That's again a structural flaw. The Oracle problem here. Now, Oracle is it's a very technical thing. There's a diagram in the curriculum. Okay, you can check that out, but I would say that just understand this particular thing. But there is a diagram in the curriculum as well. So smart contracts, they rely on oracles for real world data. If I told you that smart contracts, as an example of a collateral, it's the smart contract will hold the collateral and then will release once all the conditions are met. So they need as the data or input is what we call as oracle, right? Now the oracle is the input that we provide to the smart contracts. If the data itself is not, if I say that the data itself is not, it's incorrect, right? That means there's going to be a market manipulation. There's going to be a manipulation, right? Because the output will be incorrect. There's going to be a losses for the participants. Difficulty holding oracles accountable. Who does that? Developer 1 has provided, developer 2 has provided. We don't know. We cannot hold anyone accountable, responsible for that due to their decentralized nature. So that's one problem that you have with smart contracts. So every product, smart contracts, stable coins, the anchor with that, everything that we have just discussed about. Now, how do you address the crypto ecosystem flaws? There are numerous initiatives to address the structural flaws. For example, there are cross-chain bridges in development that should allow users to trade digital finance assets and crypto across. So there are just cross-chain bridges that you are developing. So it's still in the development stage, right? Nothing has been done. I mean, it's still in the development stage. We can understand that. Okay, what are the risks posed by the crypto ecosystem to all the participants? First, to the investors, if I talk about to the crypto investors, what are the risks? High volatile, right? You can have losses, sometimes profit, sometimes losses. Scam and fraud can happen, right? There can be hackers, scam also can happen. Exchange risk. Crypto investors can lose funds in exchanges collapse, and this has happened in the past. The entire exchange, crypto exchange, has collapsed, right? So that's the risk to the investors. Risk to governments. Well, money laundering and terrorism financing. Crypto's anonymity, no one knows who has sent. The identity is hidden in a blockchain, right? So who knows who have sent to whom? So that this can lead to these kind of activities. Tax loss revenue. Government may lose tax revenue if crypto is used for tax evasion. If that is used, that's going to be a risk to the government. Financial stability risk. Widespread crypto adoption could threaten the financial stability. If everyone starts using Bitcoin as a currency, that there's going to be a financial stability issue as well. Monetary sovereignty risk. Cryptoization could weaken government control over currency. So they will not have any central authority because there is no centralization in the entire cryptocurrency world. So that is going to be the thing that we have, the risk for the governments. What about to regulators now? Rapid evolution. Regulators struggle to keep pace with the fast changing crypto industry. That the crypto industry is changing, so there's an evolution, and even they are facing challenges to keep up with it. Jurisdictional challenges. Global nature of crypto makes implementation, one is happening here, one is happening there. So how do you regulate that? So that's a challenge as well. Illicit activities. Anonymity hinders law enforcement efforts. Even if you try to enforce the law, there's anonymity. You don't know who has done what. That's what the problem to the regulators are. Okay, risk to traditional financial institution. Obviously, traditionally, what we have been using, right? So crypto failures can impact banks with crypto exposure. So if the banks, they have an exposure to cryptocurrencies, cryptos are volatile. If they fall down, if their exchange fall down, the banks can have a huge impact on that. So there's going to be a contagion or system-wide risk. Competition risk as well. Cryptocurrencies offer faster and cheaper money transfer, potentially posing a threat. So that is much faster. That's what the risk to traditional paper-based or the currency that we have. What can be the policy actions that potentially we can take? Clear regulations. Develop comprehensive rules and laws for crypto. Have clear regulations. International cooperation among countries, right? Collaborate on regulatory frameworks to address jurisdictional issues. Innovation. Encourage positive innovation with traditional finance to remain competitive. And CBDCs is the central bank digital currency. Explore CBDC as potentially safer and more efficient alternatives. See, CBDC, I think if I talk about India, you have the UPI, right? You just transfer it. So that's a CBDC, central bank digital currency. So it's like offered by central bank. Think about that terms, okay? That's the CBDC that we have. Explore that. That's a good way to actually have a digital currency, like a digital currency, right? So that's what we have. It is a safer because it is central backed by central bank. So that's the potential policy actions we can take. So that is it. That is what we have for this particular chapter. Any questions, anything that you want to understand, any terminologies, anything that you feel that you should know, please feel free to ask. It is an interesting, little bit technical, little bit abstract as well. I've tried to use to create these diagrams and everything. It takes me time, but this is what it is. Prakash says fragmentation. See, fragmentation is this. Understand, fragmentation means what? Fragmentation is to dividing things. That's what the thing is. It becomes so congested, right? The entire blockchain becomes so congested. Let's say you have a Bitcoin, so that you develop it into a Bitcoin, you Ethereum, right? Any other cryptocurrency that you can remember. So there are if you just search it on Google, there are plenty of cryptocurrencies. So that really becomes, if you have a XYZ currency, you really cannot operate it someone else. You tell a different person, okay, do you accept Bitcoin? He'll say that yes, I do. But do you accept ABC? He'll say no. So there's a lack of interoperability. So when you do that, when you try to break down the entire network into other types of currencies, then usually these are the problems that can arise, of course. And it is something that is not, it's not going to sustain in long term as well, right? So that is what the thing is. There's going to be weaker secured. You'll rather invest your money in Bitcoin and Ethereum rather than in other XYZ crypto, right? So that's what the point is. So that is fragmentation. Basically, removing congestion. It's a that is what the fragmentation is. Having better management. But yes, if you try to use the better management, but there's going to be certain compromises that you have it here. So that is what the fragmentation is. Okay. All right. So let's move to the final chapter for today, and that is reading 103, the digital resilience and financial stability, the quest for policy tools. Now, this is, I feel that you may see it, you may not see it on the exam, but just give it a good read is all that I would say for this particular chapter. Describe characteristics of cyber risk and ICT risk. What is a cyber risk? It's a loss of confidentiality, integrity, and availability, or it's also known as CIA triad, right? You need to have confidentiality, integrity, availability of data when it comes to data, right? This is what the thing is. So a loss of CIA triad is referred to as cyber risk. Okay, confidentiality is compromised, integrity is compromised, and it's not available. It has been hacked. So that's the cyber attack. The examples is the breaches of client information, unauthorized access to a system, funds theft, and the DOS attack. I'll have to check what is this DOS. I forgot. Denial of service. Denial of service. So that is part of the DOS. Denial of service attack. Okay, something, you have the system, but you're not able to access it. So that's denial of service. Importance of the cyber risk is that ranked as significant as market risk. Can you understand? As significant as market risk for a trading desk, we rank cyber risk in that same level. Challenge is that difficulty in estimating losses due to lack of reliable data. So that's a huge challenge. Hindered development of cyber insurance. And then there is also the development of cyber insurance is also very less, so that's the problem or the challenge with the cyber risk. When I talk about the ICT risk, it is the disruptions in information and communications system that may not stem from cyber attacks. So information and communication system has been hampered, not from cyber attack. That is what we can club it, or we can refer it to the ICT risk. System has been broken down, right? Communications failure, service outage. That's the example of ICT risk. It is essential for ensuring uninterrupted transaction services. As a bank, you need to make sure that your net banking, your internet banking is working fine. That's the main thing. So it's very important. The challenge is that the dependency on technology, you're very much, everything is dependency on technology here, and it's vulnerable to system failures. It can happen. So that's a challenge, right? Now, there's a concept of cloud computing. Cloud computing It benefits financial institutions, but comes with major risk when I talk about cloud computing. So you're shared the cyber risk with cloud providers. So like AWS, the Amazon Web Services, right? So you store your data in the cloud, right? So there's a widespread adoption increases systemic cyber attack. Multi clouds reduce single provider risk but introduce complexity. So rather than being dependent on one cloud service provider, you can use multi clouds, right? You can store some data in this cloud, some data in another cloud, but that can introduce complexity as well. Frequent outages raise concerns about potential disruptions. Frequent outages can lead to the ICT disruption. So they're going to be shared cyber risk with cloud providers because everyone is using that cloud provider that is hacked. So the entire that's going to be having a widespread losses. That's what the cloud computing is. That's all that we need to know. Now, how the interactions happen between the cyber risk and the financial stability. Cyber and ICT risk at financial institutions can trigger systemic financial risk impacting the liquidity, leverage, and even the customer trust. As I said, this can be little abstract, okay, but just give it a good read, all that is there, not to focus too much on this particular chapter, okay. Integration and contagion effect. So now when you how the interactions between cyber risk and financial stability happens, how cyber risk impacts financial stability. First is the integration with contagion effects. The highly integrated nature of cyber and ICT connections within the financial institution creates the potential for significant contagion effects. So if that is so, think about it. ICT risk. The net banking is not working, or maybe a broking company, they are doing transaction, right? They are trading. The platform is not working. That's going to be a loss to the investors and directly impacting the company, right? Cyber attack. So if they both happen at the same time, right, there's going to be a significant contagion effects. Contagious. That's what the thing is. CIA, confidentiality, integrity, availability of data triad. It stands for this three key principles of cyber security. The impact of cyber incidents on these can vary, and you just got to remember this particular thing, okay? How does the cyber risk and ICT risk impact the CIA triad? How does it impact? Well, if I talk about cyber risk, it can vary. Integrity and availability are often more critically affected than confidentiality. So, integrity and availability is more critically impacted when there is a cyber attack, as against, so integrity, compromised data, availability is not available. Confidentiality is not so much of a concern when it comes to the CI triad for this cyber incidents. Challenges in predicting probability. There is a difficulty of predicting key events due to non-linear contagion effects. So now this is you really do not know what's going to happen, right? You really don't know what's going to happen. How can you predict what is going to be the loss for cyber attack or ICT risk? So it's a non-linear thing. It's not going to be like, okay, the event is this much, the loss is this much. No, it can be a non-linear like this. The losses can go very high, right? So we don't know. So that's again a challenge or interactions between the cyber risk and financial, how they interact. Now it becomes really hard to trace the systemic risk. You cannot trace it out. What happens is that if there is a cyber attack, let's suppose that if there is a cyber attack, okay, just a minute here. So something that we are missing here is this. So challenges in predicting probability. Now there is a difficulty of predicting key events to non-linear contagion effects. We know that the contagion effects can be non-linear. So what we do is We use agent-based models for simulation. Here, what we do is we use agent-based models. Agent-based models assess impacts on confidentiality, integrity, which influence liquidity. So what we are trying to do is that we understand that to predict losses, right, of or probability of these events, it's a non-linear, it's not a straight line. It's rather, it can be a non-linear path like this. So what we can use is we can use an ABM or agent based model for simulating the effect on the CIA triad. That's what we can use as an improvement. That's what suggests, which will influence the liquidity and asset values and everything. It will do that. It will help you a simulation, just like a Monte Carlo simulation. That is what the point here is. Now, the next thing is that tracing the systemic risk. It is hard to trace the systemic risk. Cyber attacks might block direct actions like a bank withdrawals, but can still cause financial contagion indirectly. Think about it. There is a cyber attack in a bank. The bank stopped the net banking so that no one can transfer it via mobile phone. But at least I can reach out to I can go to a bank and I can, or an ATM, and I can withdraw it, right? So it's really hard to trace out how the financial contagion or financial impact will be. If there's a cyber attack in my bank, if I cannot access the system, I'll immediately go to the ATM and I'll take my money out, right? So to trace where and exactly what is going to be the system wide risk, it's really hard. So we can use, again, agent based models here for simulating the behavior of individuals, like how I will behave to identify and understand hidden and systemic risk when it comes to ICT cyber risk. We are very much reliant on digital infrastructure. Financial institutions depend heavily on digital infrastructure, including the cloud computing. So quick recovery from cyber incidents is essential to maintain financial stability and continuous operations. Just pretty basic. Impact on customer confidence. Cyber risk can diminish customer confidence, potentially leading to bank runs and systemic financial instability. So that has an impact on the customer confidence as well. Okay, now this is something that you can just use it out. Specifically, the macro prudential tools are something that you should know. But financial stability policies, how can you ensure the financial stability? What are the policies and tools? Two ways that you can do it, on a micro-oriented tools and the macro-oriented tools. So digital resilience, what is it? Protecting digitally resilience, bouncing back. Protecting financial systems from cyber and ICT risk requires a two approach. Micro, that's operational guidance for individual entities. Framework policies, it's the fundamental rules for network and system operations. Okay, it's two things at an individual level and framework policies for that. So now we're going to be talking about two things here. The first one is the policy measures and micro level or micro oriented tools. Okay, micro oriented tools. So IC is the International Telecommunications Union. It implements, so this is just a union, okay? It implements cyber resilience measures, emphasizes certification and standardization for effective cyber security. Just like ISO standard and everything, you can just compare it with that. European Union, it established policies for incident reporting and information sharing. If there's a cyber attack or ICT risk, what happened? Report the incident, share the information. That's what the European Union. There's also a DORA Act, Digital Operational Resilience Act, focuses on ICT third-party risk, including cloud computing, mandates penetration stress test to improve. So this is just to give a good read. No need to remember it and no need to get too much deep into it. Okay, just the policy measures on a micro level that you can do it for incident reporting, information sharing, implement the cyber resilience measure, have a certification of the International Telecommunications Union certification for that, standardized, right, for effective cybersecurity. That's the policy measures and micro level oriented tools. At a macro prudential tools is the first thing that you use is circuit breakers. Now, circuit breakers act as a temporary pause on normal rules and regulation. They provide a temporary stoppage to some services. Think about it. If there's a cyber attack, right, you can stop the net banking for about, let's say, 30 minutes, as an example. So you can inform people and that, okay, or maybe you can just stop it, the services temporarily, you just stop it 5 minutes, 10 minutes, so that you have time to recover from that cyber attack. So that is what we call it as a circuit breakers. Okay. Circuit breakers act as temporary pause on normal rules and regulation. They give us temporary stoppage to some services. In the event of a major cyber incident, circuit breakers serve to minimize the negative impacts. Okay, so that you can just get back to, you can get back to, or you can take care of that particular risk, or there's a service outage, anything like that. So challenges include defining the severity of a cyber attack to warrant the activation of. So when do you activate this circuit breaker? That is a challenge. Now that totally depends on the severity of a cyber attack. If it is small level, high level, what is it? That's what the thing here is. So that's the circuit breaker. It's a good tool that you can use to have a temporary block on your services for a certain point in time, and then you just bring it back. Okay, so that you get enough time to work on it. That's what the point is. However, the challenges is that what is the severity, and then you activate the circuit breakers. The second is that of a cooperative arrangements. So cooperation among financial institutions has become essential for developing robust defenses against cyber attacks. So if there's a cyber attack in one bank, let's say that, then if you get to know that, okay, do not use this particular thing, do not visit this website or that phishing email, whatever that is, if there's a cooperation among banks or financial institutions, you can share it, the cyber attack details, and that, so that others can stay away from that. Information and knowledge sharing resources. So information and knowledge sharing resources facilitate growing cooperation to combat cyber threats. So have good information and knowledge sharing. That's what the thing is. Structurally, you can do something, create a structure, you can take a structural measures for that. So regulating systemically important technological institutions, not financial, technological, I'm talking about, you can regulate them, okay, who are very technologically important, right? Forced diversification, you encourage the institutions or bank to use multiple cloud providers and not being dependent to just one cloud company. Penalties for concentrated software use. If you're using a software very heavy dependent on that particular software, there's going to be some sort of a penalty for that as well. Now, ICT buffers is something, the information communication technology buffer is a part of collaborative measure aimed at combating systemic risk and ensuring rapid recovery from major cyber attack. If there is anything, you have certain amount of buffer. Co-owner bank. So what can be doing is that, let's say in my bank, there is a cyber attack. So next to me is another bank. So that another bank can allow my customers to transact on that. So that's a co-owner banks affected by cyber attacks can allow customers to transact on their accounts at unaffected banks, reducing the overall risk. So that's something that we have it here. And I think just a good read is all that is needed for this particular chapter that we have. Okay, so that is it for today. Any questions, anything that you just want to ask? And as I said, climate risk, I feel that you need to spend some time on it. 2 hours for those 3 chapters. I would say that go ahead and do that. Again, I'm telling this once again, that I'll be creating after 10th. I'll create it, okay, in a better way. I'll try to do that, especially for the principles chapter. If possible, tomorrow I'll go ahead and I'll just club it here and I'll just send it to you. Okay, so any doubt, anything that you have for current issues, remember, current issues is something that is the focus of GAR because they change it every year. And something that is changed they have a higher chance to show up or being testable. That's what the point is. So the 8 questions that you would see, you have to have a target of getting first quartile in financial current issues, right? It's not complicated, it's not difficult at all. This is what the point is. Okay, so tomorrow I'll be catching up again with the credit risk tomorrow, and day after that I'll complete the credit risk by Monday. We'll complete that, and then you'll have a better grip on that. One day for risk investment, and that would be it for the liquidity then. So let's wind up. Thank you so much for attending so far, and you all have